We don't quite know what's happening in the US economy, and that's something that other central banks are looking at.
The US exceptionalism story, we think, still has some legs.
I think that America has still got a very good narrative.
There's just no interest for anything except the US.
For the moment, US exceptionalism is a story that's really, really hard to push back on.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City for our audience worldwide. Good morning, good morning. Bloomberg Surveillance starts right now with equity futures on the S&P 500 just about positive by a third of 1%. It all comes down to this. The final Fed decision of 2024 at 2 p.m. Eastern Time. We'll get a Fed decision widely expected to be an interest rate cut. 30 minutes after that, Bramo, we'll hear from Chairman Powell.
And does he sound dovish the way he has many times before? This, to me, raises a really key question, and you and I have been debating this extensively. What will the market's response be to a Fed chair that comes out more dovish versus one that tries to stay the course and actually re-emphasizes the threat of stickier inflation? It's not so clear-cut that the market will embrace just outright dovishness.
Where it is clear-cut, where there is some consensus, they cut today and they skip tomorrow. That's what a lot of people seem to think coming on the show.
Torsten Slok last night was on Bloomberg, and he was talking about the fact that regardless of what happens, even if they cut, rates will be higher for longer. And he says all of this has to do with policies potentially next year. What happens when you are cutting into a reacceleration maybe of the economy because of policies in Washington like tariffs and like tax cuts?
So this was described as a recalibration phase. This will be 100 basis points of cuts across 3 meetings. Feels like we're going into something else with a different cadence. I wonder how you describe it, but it certainly looks like this Fed chair is looking to get some optionality into a very uncertain 2025.
And the market's giving to him. And that's basically what I think is really interesting. How is he going to embrace it while not seeming like he's simply following whatever the market gives him? I thought it was fascinating. Jim Reid over at Deutsche Bank had this note, and I really thought it was insightful, that this is the 3rd year in a row that markets have overestimated just how dovish this Fed would be in terms of how many rate cuts there would be. To me, basically, and as Julian and Emanuel pointed out, stocks haven't cared. So you have higher rates, you have equities that keep pounding out returns, and it raises the question of where the market's saying this is stickier inflation and not that restrictive of a rate.
Andrew Hollenhorst, though, was just on, and he was saying how, given the fact that this Fed is so data point dependent, if they see any uptick in the unemployment rate, potentially then you could see a cut in January.
Do you want stat of the morning? Every single Fed meeting so far this year, with the exception of September, the 2-year has rallied. Yields have dropped at the front end. Chairman Powell, we talked about this a few times. He likes this one gear, and that one gear is dovish. Will later this afternoon be any different?
Good question. I think if you look at Nikolayevsky, or if you look at one particular person over at the Wall Street Journal, it's talking about, the potential for this Fed chair.
Such a hard time.
Well, okay, I think it's wonderful. We're all jealous of you. I think it's great. You are the earpiece of the Federal Reserve. It just raises a question. He had to talk about how the 50 basis point rate cut came at the basically the cajoling of other members saying we will be much more moderate later on. Does he really pivot in a way to acquiesce to them, or is there basically the same kind of dovish tone?
He being Powell and not Nikolayevsky, of course. In the bond market this morning, yields unchanged on a 2-year, unchanged on a 10-year. We traded about 440 on a 10-year maturity. Coming up this hour, we'll catch up with Julian and Emanuel of Evercore, looking for the S&P 500 to hit 6,800. We'll catch up with Elyas Galou of Bank of America on a super bullish global fund manager survey, and we'll speak to Veronica Clark of Citi, looking for the Fed to keep cutting interest rates. We begin this hour with stocks rising as traders await the final Fed rate decision of 2024. Julian and Emanuel of Evercore optimistic heading into 2025. A combination of the long-lasting after effects of pandemic-era stimulus and the AI revolution will support the S&P 500 to 6,800. Julian joins us now for more. Julian, good morning.
Good morning.
What happens at 2 p.m. Eastern Time this afternoon?
Well, we're going to get a 25 basis point cut. We know that. Our central bank's policy team thinks there's going to be 3 more next year. But the question is the messaging of it. Look, as Lisa pointed out moments ago, the market has been very good at reducing the number of expected cuts, and it hasn't really mattered. And, to us, north or south of call it 3 out to next December is probably the right way to think about it, in terms of the handicap. But the question is what's the message on how things evolve given the potential for inflation to be sticky in here.
Whatever happens, you're bullish into next year, 6,800. Not as bullish as some on the street, north of 7K. We've heard that from the likes of Wells Fargo, from Deutsche Bank, from John Stolfus over at Oppenheimer as well. Bank of America put out a note yesterday. We can stay in a bubble longer than you can stay underweight. Are things frothy into 25?
There are certainly parts of the market that are very frothy. Crypto, anything is incredibly frothy, that we know. Other aspects of the quote-unquote Trump trade certainly are frothy. But we'd think about it more as you think about the first quarter of 2021, right, where you had lots of froth in the meme stocks, in SPACs, in profitless tech, and they really crested in that period, but it did nothing for the cadence of the overall market. The overall market kept right on going, and for us, close to 10% earnings growth next year is the thing that can continue to propel stocks higher.
Just to combine John's two questions, he starts by asking about the Fed and what they're going to do, and then the bullishness, the fact that stocks haven't cared. At what point is there a connection between what the Fed does and the reaction by stocks? In other words, if they cut, at what point does that give an extra boost to stocks? And if they don't cut or even raise rates, at what point does that torpedo some of the gains that we've been seeing?
So in our mind, it is really a function of the 10-year yield. And remember, let's go back to September when you had the initial 50 basis point cut. The surprise to a lot of people was that yields on both the long end and the short end rose as briskly as they did. Well, the only other time that actually happened at the start of a cut cycle was 1995, the virtuous only real soft landing, ostensibly till the one we have now. But from our point of view, it's not just where policy goes at the Fed, but where policy goes in the White House, based on where the bond yield goes. Over 4.5%, there'll be questions. Over 5%, which is not our base case, is where markets and assets generally and policy runs into headwinds.
Are we getting a small taste, a preview of which stocks do best if yields inflect upward a bit? In other words, we saw this sort of lack of broadening out, this isolation in the Magnificent Seven and big tech over the past couple of weeks. We've seen the longest run of more decliners than advancers in the S&P 500 in more than 100 years. We've seen 12 straight days of that. Is that what we can expect going forward if yields don't materially come down?
That to us is perhaps as much of a seasonal bias as anything else. There's a tendency, particularly when you've got animal spirits rekindled on the part of the investing public, which clearly we have had post the election. They tend to want to press the winners into year end, and obviously we've known what the winners are. In fact, that actually tends to reverse in January, so we wouldn't be surprised if there was a bit more of market volatility as those winners pause. Doesn't say much about the rest of the year because we think those names will lead the rest of the year. But it does say that if we get into this environment where speculation grows ever more, that those are the names that could get you into what we would consider potentially overvalued territory.
Well, we see a lot of speculation about policy. And you were just mentioning the fact that maybe at 5% on a 10-year yield, that would start to get the market nervous. Is that the third rail, maybe, potentially, for this White House?
No question. No question. And the market told you what it thinks when the appointment of Scott Bessent caused bond yields to fall, very materially over the next several weeks. And that was, balm for the post-election rally. And we think that, with someone like Bessent at Treasury, attention will absolutely be paid. Because remember, if you go back and you think about 2018, the mistake is that policy got muddled with the fact that inflation was stickier. But the real thing, and caused the fourth quarter of 2018 sell-off, was that the long-end bond yields started rising too much uncomfortably.
If that's the ultimate check on policies, what do you think the policies are going to be?
Well, we know the intent is to promulgate tariffs. We know that the other key will be tax policy extending the original cuts from 2017-18. and of course, immigration. And in aggregate, most of the financial modeling, and I'm sure most of the people that you talk to, say, A, they're inflationary on balance, B, they expand the deficit, and C, they may not necessarily be as pro-growth as expected. But as was the case in 2018, we have to see how they get implemented.
It's potentially a bigger problem for the rest of the world. And we've seen that story play on repeat over the last few weeks. Take the data of this week, Lisa. If you look at the retail sales of yesterday, pretty strong. The services PMI the day before, pretty strong. You compare that to what we saw in Germany. Business confidence, rock bottom, terrible. Retail sales, consumption numbers out of China, awful compared to expectations. Just not good relative to the rest of the world. The rest of the world is really struggling.
And we've seen this isolation, and I think that that's really one of the key questions for 2025. How far can that divergence go between the U.S. and everybody else when it comes to rate differentials, when it comes to the currency, and when it comes to just economic growth with the U.S. driving the rest of the world?
Julian's going to stick with us, so we'll have some time to talk about the rest of the world. But my chart of the year for 2024, the Chinese 10-year yield, falling. And falling rapidly, and then some. That is a very different world compared to the one we're talking about in the United States.
Yeah, record low now for their yields. Do you have a book of the year, too? Are you going to have a book of the year every 2 months?
I leave that to TK.
Are you going to have,
I leave that to TK.
You know, but he tends to have a book of the year every 2 months or 1 month.
Book of the summer.
The book of the summer.
It's like the book of the season. I'm not sure what the book of the summer was. Do you know what it was?
Yeah, I have no idea. It changes. It changes depending on the week.
We'll find out. We'll find out later on the Fed show. Look out for that a little bit later. TK will bring his book of winter and spring of 2025 ahead of time for you a little bit later, so look out for special programming. Let's give you an update on stories elsewhere this morning with your Bloomberg brief. Here's Yahara Hacker. So, Yahara.
Good morning, John. President Joe Biden expressing support for a stock trading ban in Congress. In an interview with More Perfect Union, Biden said nobody should be able to make money in the stock market while they're in Congress. It's unclear what impact the comments will have, as several previous attempts to ban stock trading by lawmakers have failed. Meanwhile, Boeing is resuming full jet production in the Seattle area after shutting down for weeks due to a lengthy worker strike. According to the head of its commercial jet division, Boeing has now begun building the larger 767 and 777 aircraft again. The company cautioning getting production back to speed will take time, though, because some workers need to be recertified and components may be out of position. And the two NASA astronauts who've been stuck in space since September will have to be there longer. According to NASA, their mission has been extended again, and the pair will now return in late March or early April because of a delay in launching their replacements. The two test pilots planned on being away for 8 days when they blasted off in June, but multiple issues with Boeing Starliner prompted NASA to leave them behind at their International Space Station. That's your Bloomberg Brief. John?
Yahara, thank you. How isn't this on the news every single day? You go up in space in the summer, you expect to be there for 8 days, and it could be pushing 12 months.
I want to send them cards. Can we send them board games? If you know of someone that we can send, board games, candy, just something.
How are you sending them cards? What are you talking about?
I don't know. What do they do all that time?
About?
It's Wednesday.
All right. Up next on the program, sky-high investor sentiment.
Sentiment is very positive. If I had to summarize it, people are long U.S. versus rest of the world in the equity space, and it's going to take something to kind of shift that trend.
It's like Elon Musk turning into Royal Mail. Like, what's going on here?
Well, I feel bad for them. What do they do with all their time? Do they just sit there
a raise in the
and stare at the moon?
It's a long day ahead of us from New York City this morning. Good morning. The Fed decision later on this afternoon. The S&P 500 struggling to string together 2 days of gains on the S&P. Negative breadth every single day through the month of December so far. Equities this morning up by 1/3%. In the bond market, just about unchanged. Your 10-year yield, 440.27. And the surveillance this morning, sky high investor sentiment.
Sentiment is very positive, but I think sentiment is positive for a reason. The economic growth has been surprising to the upside. There is a view that the deregulatory and tax impulses from the Trump administration are going to be positive. If I had to summarize it, People are long U.S. versus rest of the world in the equity space, and it's going to take something to kind of shift that trend.
So here's the latest this morning. Bank of America's latest global fund manager survey finding sentiment is super bullish, showing cash allocation at a record low, with U.S. stock exposure at an all-time high. The team writing the December jump in global macro sentiment was led by greater optimism on U.S. growth, with the highest percentage of fund manager survey investors expecting a stronger U.S. economy since at least November 2021. Joining us now is Elyas Galou of Bank of America. Elyas, I want to come to you on those 2 points. Record low cash allocation, record high allocation to US equity markets. From the standpoint of you and the team, is it time to think about leaning in the other direction?
Hi, John. Great to be here. Look, I mean, historically, these moments of extreme positioning, because that's the bottom line of this month fund manager survey, that positioning is extreme at the moment. It's all about the US. Everyone is long the theme of US exceptionalism, and historically, this kind of extreme positioning has often been followed by turning point in the market. There are also orange signals that have been flashed by this survey. If you particularly look at the cash allocation, it dropped below a certain key level. Historically, it meant that risk assets are either facing the top or experiencing a sell-off. And more importantly, when you look at one particular metric that really stood out this month is the fact that investors are running a record underweight in terms of their positioning regarding cash. And that historically has coincided with big top in risk assets in the past 25 years.
Elyas, a big top potentially for U.S. assets, or more broadly, given the fact that the overweight is securely in the U.S. and not necessarily overseas in Europe?
You're absolutely right. As you guys just said, there is a record high allocation to US, and the allocation to US is even more striking when you compare it to the rest of the world. The FMS investors are the most overweight US versus EM or Eurozone equities since June 2012. So here as well, there is extreme positioning. We think more that the overshoot that's probably going to happen in the first quarter of next year, it will still favor US assets, equities and the dollar in particular. But then at the time in Q1, it will be a good opportunity to shift in favor of international assets, where positioning is way more favorable and also valuations are much more favorable than the US.
Elyas, I don't want to say these words because I'm going to get pilloried, but is this time different? Have you found in your final survey of this year that some of the sentiment indicators haven't had the same kind of read-through in future market performance as they have in the past, just because this is a unique time with unique and fundamental structural divergences?
Look, absolutely. I mean, this time is different in terms of the fact that we have never seen, for instance, the behemoth of the Magnificent Seven group of stocks in history. I mean, when we ask investors about the most crowded trade for 21 months in a row, they've been saying that long Magnificent stocks is the most crowded trade. And the fact that US also look very exceptional is also because the rest of the world looks very unexceptional. There's a lot of concern regarding growth opportunities in the rest of the world. So this time is different because the divergence that we see has never existed in the past. But historically, when we go back to the surveys, the kind of tops and extremes that we see in positioning, the fact that cash allocation is low, the fact that cash levels are also low, has often coincided with a turning point, and we are cognizant of that.
Where are the contrarians going, even though I know there's very few of them?
Who are the contrarians today? I mean, if those who believe there will be a Q1 overshoot just because growth will surprise to the upside, particularly in the US, those contrarians should be looking at international assets, at commodities as well. The allocation to commodities just dropped to the lowest level since June 2017. So international assets, Europe, commodities, these would offer the best opportunities. But the true contrarian entering 2025 are those who think that economic growth will be surprising. On the downside, those who still believe a hard landing is possible, and those should opt in favor of cash and bonds, really.
As you're saying that, Elyas, Lisa's sitting there nodding her head.
Okay.
Just nodding her head.
No,
it's almost instinctive. It was just like reflexive. Didn't even have to-
Hold on a second. That's not true. I was just thinking that really is contrarian right now, to think about a downturn. And then I was thinking about Andrew Hollenhorst.
Sure, yeah.
Was that it? Or was she thinking, he's describing me?
I think Brahma was just scared by the fact she said this time might be different, and then was like, no, bad growth, bad growth. Elyas, thank you. Julian and Emanuel still with us around the table. Julian, good to see you. I want to talk about what Elyas was talking about, the international backdrop, and the question that Anne-Marie asked. The most contrarian trade right now surely has to be to buy the rest of the world.
No question about it, and we are getting a lot of questions about it. But look, if you think about the last decade, valuation alone, the disparity was not the proper catalyst to own the rest of the world versus the U.S. or versus the Mag 7. And we don't think that's the case yet. What we want to see are a couple of macro turning points, most especially a peak in the dollar. We are at all-time levels. And we've seen, the Brazilian currency in the headlines yesterday, really all of these currencies. And when you think about it, recall back to the first Trump administration, there was a time when President Trump became uncomfortable with the strong dollar.
True.
So if we get messaging like that at some point, if in fact the economy maybe shifts lower for some unexpected reason, that's when we think the move towards the rest of the world. And then the other thing, and you pointed this out earlier, is that particularly with regard to China and the message it sends the rest of the world, yes, we understand they're trying to reflate, but the bond market is telling you it is not successful at this point.
What is going wrong in China right now? What does that chart that we talked about, that chart of Chinese bond yields just rolling over aggressively, what does that scream? What does that tell you?
It really reflects to the fact that the dynamics around the property market are very complex and are likely a longer-term workout than, any short-term stimulus patch.
To go to that point, there is this feeling, and Elyas Galou is talking about how one of the contrarian ideas is a downside shift to growth. How much is that only in the United States, and does that coincide with a top in the dollar? And I ask this because we certainly aren't seeing a downside to growth in China, as evidenced by the yield chart. We're seeing a downshift in Europe. So how much is that kind of what has to happen to send the dollar lower and to reverse a lot of the trades?
Well, that would be sort of the likeliest series of events. But I would also say that, if you think about things geopolitically, if you were to see a greater semblance of calm, either on the Ukraine-Russia front or in the Middle East, that could be the catalyst for the lower dollar, and that could actually be the catalyst for more confidence in a higher potential growth trajectory in Europe. So that's the virtuous case, and it's certainly possible.
Foreign exchange is a relative game. It's a relative story, and we've asked the question on repeat over the last few weeks, how little needs to go right in Europe to get this trade to go in the other direction, given how depressed expectations already are.
We've been talking about that. I've been waiting for some upside surprises.
You've been looking for some good news?
Yeah. It's been a little rough, Lowest business confidence going back to what, 2020? I saw that and I'm thinking, all right, I think you just need to kick the bar up a little bit higher.
Still my favourite question at the moment, though, for the end-of-year quiz. I talked about this with you in the green room. Ask someone where they think the DAX is year-to-date. The DAX year-to-date is up by more than 21%. Which is amazing. That's the benchmark in Germany, up 21%.
I need to take notes because I'll know what your year-end question is, I'll know what your year-end chart is, and I'll be able to ace the quiz at the end of the year.
Book of the year, we'll get that a little bit later. Special programming, the Fed decides, Bloomberg Surveillance special, we get TK's Book of the Year.
Book of the summer, Book of the winter, Book of the spring.
Looking forward to that. What time does that start, 1:30?
That starts at 1:30, yes,
1:32?
Yes.
1:32, so precise around here, aren't we?
I mean,
1:32 Eastern
that's
time.
what your mind thinks too, don't even lie, come
Julian,
on.
it's good to see you.
Good to see you.
Thank you, sir.
Thanks.
Julian Emanuel there of Evercore. Up next on the programme, we'll catch up with PG&E CEO Patti Poppe on the Biden administration's $15 billion loan offer. Average price target on the S&P 500 into year-end next year, 6,600. The high, 7,100. The low, 6K. Very bullish going into next year compared to where we were last year looking at 12 months when the average, and I've got it in front of me, Lisa, the average for this year, year-end, 48.33 on the S&P 500 12 months ago, looking at 12 months.
So what did people get wrong? Two things. One, they got wrong how this market would respond, equity market would respond to higher yields. They didn't get wrong just how low yields would go. In fact, they expected them to be even lower. And two, they underestimated how long the Magnificent Seven could remain leadership, because ultimately they have continued to power returns even amid a couple brief signs of broadening out.
And to some extent, they've been conditioned by that, looking out to 2025. So equity futures right now up by about 0.25%, on the Nasdaq up by something like 1/3. In the bond market, going into that Federal Reserve decision on a 2-year, a 10-year and 30-year, we shape up as follows. Yields just about unchanged on a 10-year maturity at 440.27. At the front end of the curve on a 2-year at about 425. I was comparing where we are now to where we were the last time we had a Fed decision. At the last meeting on November 7th, the close on 10s, 432.57, on 2s, 420. So we haven't moved too much since the last meeting.
No, but to the extent that we have, it's been up. It's been the market ratcheting up expectations for longer-term neutral rates and really kind of throwing a question for the Fed. Just how restrictive are we? And really, how much further are we from neutral, given the fact that this market seems to be showing no signs of falling off the grid?
As those yields have stayed elevated, it's fueled that US dollar trade, the dollar a whole lot stronger. We've repeated this stat over the last week or so. We've only had one down week for the DXY dollar index for the fourth quarter so far. Euro dollar clinging, and I think that's the right word, clinging to 105.
So it raises this question, when do we get to that peak dollar? We talked to Julian Emanuel, and he said that would really be the tipping point, at which point you could start to invest internationally. How far do we have to go there before it becomes a problem for other countries, as well as for the United States, where you have a Trump administration that wants to increase exports at a time where they're getting increasingly expensive for countries around the world?
The news is just bad elsewhere. Look at Brazil. Julian talked about it. We're talking about 6 against the US dollar. Down in Brazil, in Canada, talking about levels we haven't seen since 2020. It's not just Europe, it's everybody else.
And it raises, though, again, why isn't the dollar stronger? If the dollar gets stronger, does that become a problem in terms of rearranging things? But you're right. There's no reason not to lean into the dollar right now, because who are you going to get excited about? I mean, honestly, are you going to get excited about Germany? Are you going to get excited about Canada? They're having, what was it? A friendly holiday spat?
Did you see the come by our moment?
A
Trudeau
festive holiday
to his
fight.
party? Yeah, we'll talk about this a little bit later. DXY pushing 107. Under surveillance this morning, lawmakers unveiling a bill to extend government funding into March, infighting among House Republicans over attaching funds to agriculture, disaster and other priorities, threatening to take Congress right up to Friday's midnight deadline. I believe Elon Musk pushing back against this bill as well, right?
Yep, he's saying this bill should not pass, and then he posted a photo of the mammoth bill and said, ever seen a bigger piece of pork? Also in this bill, this Christmas tree, if you call it, because everyone's throwing an ornament on it at the end of the year. This is something Speaker Johnson wanted to avoid and actually was the downfall for former Speaker Kevin McCarthy, would also give lawmakers a pay rise. This is going to be very controversial within the Republican Party, so they're going to need Democrats to get this over the finish line in the House.
My favorite is people talk about these highfalutin goals, these good policies, and then we come down to it. It's, can we pass a budget? I don't know. Can we throw a couple more things in it? It just gives you a sense of how quickly this government can move.
My favourite, and the reason people really dislike politicians, there are many, but here's one.
People.
An individual that has been in Washington, D.C. for decades. How many decades? 4, 5? I'm talking about the president here.
Talking about Biden,
OK. On his way out, on the last few months in Washington, D.C., decides that they shouldn't be able to trade stocks in Congress. Where's he been?
Well, I personally think this might be personal for him.
You think it's about Pelosi?
I do think this might be about Nancy Pelosi. I don't think the two have spoken since she, threw him under their bus, pretty much, and basically pushed him aside and said, it's time for you to step down. You need to pass the baton on. Of course, I'm talking about in the summer when he then passed the baton to Kamala Harris and then she lost. And there's been a lot of speculation about the fact that her husband is an investor. And I think maybe this is directed towards her.
This feels like when you leave high school and you tell everybody what you really think in the yearbook. That's all. I'll leave
Did that
that
happen
there.
at high school? That from experience?
I'm just saying.
Let's get these little tidbits from Lisa.
Let's just move on.
About what childhood was really like. Let's move on to this. The Biden administration set to open a trade investigation. I want to read that. Into Chinese semiconductors. Sources telling Bloomberg the probe could result in tariffs or other measures to restrict imports on older model semiconductors and the products containing them. That includes medical devices, cars, smartphones, and weaponry.
So they've been debating this for months, and kudos to Jenny Leonard and Josh Wingrove for scooping this, whether to initiate this investigation under 301 under USTR. What the interesting aspect of this, if they were to go ahead with this probe, the Trump administration needs to pick it up. But I really see no daylight when it comes to China and when it comes to semiconductors, and I think they would be happy to pick up this investigation.
That's the latest down in Washington, D.C. I wanted to squeeze in this story as well. Nissan in talks with Honda about a possible merger, a deal that would create the world's third largest automaker. Sources telling Bloomberg discussions have accelerated after Foxconn approached Nissan about taking a stake. Bloomberg's Craig Trudell joins us now for more. Craig, talk to us about why this is happening and why this is happening right now.
I think, in short, it's a matter of sort of disaster and trying to avert it in the case of Nissan. Honda has been sort of reluctant to do something like this. There's been talks for months about these companies potentially working together, but on a smaller scale, sort of select projects, maybe some cross shareholding, but not an out-and-out merger. And I think, we know that years ago when Carlos Ghosn was sort of unceremoniously pushed out at Nissan, Japan's government was very concerned about the long-term future of the company, and those concerns have only been, sort of realized. And they saw in Honda a potential sort of savior in terms of a fellow Japanese partner who could help them weather crisis. And what we've seen just in the last few years since then is, a company that's gone from crisis to crisis that really has not been able to get out of its own way.
It's looking more and more like a distressed asset as the days go by. Craig, we'll spend some more time with you before year-end to talk about this. An update there from Craig Trudell out of London. Elsewhere, the Biden administration offering PG&E a loan of up to $15 billion for projects including upgraded hydropower generation, battery storage and transmission lines. The Energy Department saying it will help the California company meet increasing demand and lower consumer electricity bills. The PG&E CEO, Patti Poppe, joins us now for more. Patti, it's good to see you.
Good morning, John. Nice to be with you.
How close are we to closing a deal?
Well, we have conditional commitment. That was big news yesterday. A couple of weeks. We think within the next couple of weeks we could finish and close the deal.
How transformational would it be? What would this enable you to do?
This enables us to save money for customers. This is a straight pass-through to all of our customers in PG&E service area. We could, over the life of the loans, we would save over $1 billion for customers. It's a replacement for other traditional debt financing, and it's just a lower interest rate fundamentally, and so up to about $100 million a year in annual rate savings for customers. Listen, when electricity is essential to powering the growth of California, we need to make sure that it's affordable.
It raises a question, especially as we have a number of private capital infrastructure heads come on our show and talk about how much interest there is from the private sector to finance some of these projects, and that the future ahead really is these sort of private-public partnerships. I'm just wondering how much you're thinking about where you're going to want public financing and where you see private financing for coming in.
Well, I think it's a pretty standard mix. We just did a big equity issuance a week ago. We completed all of our equity funding for our 5-year, $63 billion program. So we did a $3 billion equity raise last week. We combined that then with traditional debt, just traditionally. In this case, this actually just acts as financing. There's no role for the government in the projects themselves. We do the work. Our labor, our workforce, they deliver the benefits to customers, and we just get it at a lower cost.
How urgent is it to really build up the capacity to produce power right now? We talked to everyone about some of the data plants and how much energy they require, in addition to extra cooling and a whole host of other necessities. How instrumental is it for there to be additional capacity in order to prevent prices from becoming astronomical?
Yeah, I actually see the opposite impact. We call it net beneficial large load. This is a great opportunity for the industry to add new customers, new use for our product. We have an underutilized grid. In my service area alone, we have our grid is utilized about 45%. So all this new demand from electric vehicles, building electrification, and data centers and AI and large load can be net beneficial for customers. We see an additional gigawatt of data center load can reduce customers' bills 1 to 2%. Add another million EVs, bills can go down 2 to 4%. We see new electric uses as the first time in decades that we can actually see load growth that lowers the cost of energy for everyone, fully utilizing assets, reducing the costs.
This loan is coming at an interesting time, though. One, it needs to be finalized before a new administration comes in. Do you think you'll get it done before January 20th? We're some 30 days out. And if not, do you think this could happen under a Trump energy department?
Well, number one, we're optimistic. We've been working hard with the DOE to get this done for months. It's culminating now. I do think the Trump administration shares our value of the importance of the grid and powering the onshoring in America, powering new data center, remaining the global leader in AI will require power. So having a better grid is going to be good for everyone, and we think the Trump administration will see the value of that too.
Has there been communication with members of the transition team and your company?
Yeah, we haven't been talking to them. We're focused on finishing the year strong and really making sure that we deliver for customers here as we wrap up the year.
For 2025, what kinds of changes are you expecting, whether it's just with the regulatory framework or just the desire to do some of the things that you're talking about, to broaden out the efficiency of the grid? Do you see some structural changes to the approach that companies and the government have?
I do think we're going to have to get faster at permitting. Permitting reform, I think, could be a big agenda going forward. We're excited about building new infrastructure that lowers customers' bills, and so we need to make sure that we can do that safely and environmentally sound, but do it quickly. And the faster we can move, the faster we can power really a growth era for our company. We see ourselves as very much a growth utility. We have created real visibility to both our dividend. We're going to maintain a lower dividend than the sector as a driver for creating investment capacity, and so we can build out this infrastructure to best serve the people of California. And I think it serves as a model. We have a really exciting project in San Jose where we're demonstrating new housing units being built, 4,500 new housing units. Housing is in shortage in California. 4,500 new housing units, all electric, with 3 data centers in downtown San Jose that are net beneficial with heat capture to help offset the cost of that electric usage in San Jose. It's going to be a net zero city, and we're pretty excited about what that means for the people that we serve.
You talk about trying to diversify your use case for your grid, including electrification and including basically recharging cars, like Tesla charging stations. How concerned are you about the tiff between California and Tesla and Elon Musk and some of the build out in California as a result?
Look, I don't have a tiff with Elon Musk. He has built a great company. We're working closely with him and his company. They've been a great customer of ours. And in fact, together we have implemented some new, what we call distributed energy resource management tools, so we can build out their infrastructure faster. Tesla wanted a 3.8 megawatt charger station. And by our traditional methods, we told them you can have that in 4 years. Like, that we were so slow. And then we realized, actually, with the right tools and right dynamic load management, we could get them that capacity that day. So we've changed the way we serve customers. Tesla's made us a better operator, for sure.
Would you like to be our resident UFO expert this morning?
We are a big drone operator.
I know you are. Tell us what we need to know. Do we need to get used to this?
Look, drones have really important rules and standards within which we operate. We have a huge drone fleet. We use them to monitor and inspect our assets. We were one of the first utilities to get outside of line of sight operating rules and access. So in fact, we can have an operator in a command center operating a drone 200 miles away, monitoring and managing our lines. We've increased our inspections by 600% as a result of the use of drones. I'm not flying them over New Jersey, in case anybody's wondering.
Someone might want to know.
I love it.
Bedminster in mind.
Yeah, we're not that far, but we use drones very actively and safely. to make sure that we're monitoring the best use of our equipment.
Patti, it's good to see you.
Great to
Appreciate
be
your
with you
time.
guys.
Enjoy the holidays. Thanks for being with us. Patti Poppe there, the PG&E CEO. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Yahara Hacker. So, Yahara.
Hi, John. Luigi Mangione was indicted in New York on first-degree murder charges in the shooting death of United Health executive Brian Thompson. Prosecutors say the shooting was a premeditated act of terrorism. If convicted, the 26-year-old would face life in prison without parole. Mangione is currently being held in a Pennsylvania state prison, though the Manhattan District Attorney said Mangione may drop his objection to extradition and could be returned to New York by the end of the week. And on those drones, the Pentagon has denied involvement in the drone sightings over the northeast of the U.S. The Defense Department said none of the drones are being flown by the Pentagon or are part of secret government tests, as conspiracy theories have emerged online. President Joe Biden also commenting last night, saying, quote, "We are following this closely. So far, no sense of danger." And Elon Musk is considering giving up to $100 million to Nigel Farage, the leader of the populist Reform UK party. After the two met at Trump's Mar-a-Lago resort on Monday, Farage wrote in the Telegraph that he's in, quote, "ongoing negotiations with Musk about the donation, which would be the largest ever to a UK political party. A significant donation from Musk could boost Reform's chances in upcoming elections." That's your Bloomberg Brief. John?
Yahara, thank you. Amazing shift in British politics. Up next on the programme, the final Fed decision of 2025.
Powell, who always likes to surprise us, he may have another surprise in store for 24, and that is, I think the market's gotten a little bit too concerned and hawkish about inflation. I think you may see a Powell that's a little bit more dovish than what the market's expecting.
I'm already skipping a year. The final Fed decision of 2024. I'm looking forward to the final decision of 2025 as well.
It's setting us up for 2025.
There we go. Thank you, AMH. From a beautiful New York City this morning. Good morning. Two weeks left of 2024. Equity futures right now on the S&P 500 pushing higher by close to 1/3%. Bond yield stable. Going into that Fed decision, the 10-year 440.27. Under surveillance this morning, the final Fed decision of 2024.
Powell, who always likes to surprise us, he may have another surprise in store for 24, and that is, I think the market's gotten a little bit too concerned and hawkish about inflation. I think you may see a Powell that's a little bit more dovish than what the market's expecting. What you may see him do is deliver the cut in December and then talk about how their rhetoric is really about a reduction in pace, not in a reduction in direction.
So here's the latest this morning. Investors are awaiting the Fed's final rate decision of the year. Traders widely expecting a third straight interest rate cut. Citi writing the following: softer jobs and inflation readings for November have not changed the market narrative that resilient activity and sticky inflation will allow only shallow rate cuts. Chair Powell may sound dovish relative to this consensus. Citi's Veronica Clark joins us now for more. Veronica, it's good to see you.
Good to be here.
I'm pleased you framed it this way because I think it's really important on any Fed decision day. When people come on the programme and say, I expect Chairman Powell to be hawkish, I always think, well, hawkish relative to what? Relative to the last dot plot, maybe. Relative to market pricing for 2025, that's a higher bar.
Yeah.
Is that how you think about things too?
Yeah, absolutely. I think the market has set a really high bar for how hawkish Powell can sound, and he can easily underdeliver on that. I do think that we've had some data in the last couple of weeks that is going to give the Fed more confidence that the labor market is slowing, inflation is easing, and I think they will see that dynamic as an evidence that rates are restrictive and they don't need to be, and you can take rates lower.
It seems like you have simpatico with Chair Powell's view of the world, which might be a bit more negative in terms of the economic growth trajectory than at least market consensus. And I take a look at some of the recent data that people talk about as showing resilience, and you point to all the holes, all the reasons why you can interpret it negatively.
Yeah.
What do you think the market's getting so wrong?
Yeah, I mean, I do think Powell maybe shares our more dovish, sentiment. For us, it really comes down to what we're seeing in the the labor market. We do see, and I think everyone agrees on this, very low hiring, low quit rates, very low churn, still low layoffs. And I think most people will look at that and say this is a normalization after, tight labor markets of the last couple of years. The issue is that kind of labor market would look indistinguishable from how labor markets look before recessions. Before you get that nonlinearity, you get to the layoffs and the unemployment rate rises much more sharply. Until hiring picks up, I still see that as a very clear risk.
Okay, I don't know what's wrong with me this morning, but is this time different in the sense that essentially...
It's the second time.
Not even 7 a.m.
Hold on a second. Let's just be honest. People are talking about a new investment cycle. People are talking about an AI revolution. People are talking about lower regulations and lower taxes. Doesn't that set up a very different landscape than, say, one that fosters mass layoffs?
Yeah, no, absolutely. And we'll see if there are the animal spirits post-election. Unfortunately, I think there is just still a lot of uncertainty around what to expect next year. And if this has been a labor market that's been weakening for a while, I don't really see that changing in the next couple months at least. We have been running 2 to 3% GDP growth for over a year. Financial conditions are pretty easy, new highs in equities every day, and still the unemployment rate has risen by almost a percentage point. So what happens if that dynamic changes?
Well, what happens if we get stricter immigration policy from the incoming Trump administration? How tighter could this labor market actually move?
Yeah, that probably would be net inflationary, to the extent that we have had some strong immigration, of course, the last couple of years. That has probably helped to loosen the labor market some, bring wages, down. I think the issue is that we're really not going to get a whole lot of clarity or action on any of those policies until maybe late 2025. So for the
late 2025,
I would think so. Until we actually see, actions, it will take, legislation and things like that. So I don't know if we're going to get, in the data, the impact of a lot of these policies.
Out of all these policies circulating and speculation, what Trump has said, there will be executive orders almost immediately, but maybe the impact we won't see. What are you most nervous about?
I'm maybe, in terms of new policies to expect, I'm maybe most nervous about if we do get some big cuts to government spending. We'll see, if that does improve efficiencies. Maybe you don't get the big hit to growth. But we already do have a little bit of a fiscal drop-off in the next couple of years. We had the CHIPS Act, the Inflation Reduction Act, and infrastructure. A lot of that spending was front-loaded, for 2023, 2024. So it is already slowing for 2025. That could be a bigger fiscal cliff if you get big cuts.
Can I answer that question? Lisa on the edge of bullish is what I'm most nervous about.
Yeah, it's a little scary.
Okay, hold on a second.
I don't recognize her.
There is a narrative out there that there has been a complete shift in the business cycle.
It's been a shift,
cycle's
all right.
died, et cetera. I'm just entertaining. What if this time is different? What if people feel more bullish?
What did the JetBlue CEO say yesterday? In terms of the antitrust environment, can't get any worse.
Can't get any worse. That was a big takeaway from yesterday. Veronica, it's good to see you.
Yeah, good
Appreciate
to
your time. Thank you. Veronica Clark of Citi saying that Chairman Powell could be dovish relative to expectations.
I'm not bullish. I'm just making the
back to that
argument.
again.
I just think it's important to understand that right now there is a reason why people are so overweight in a certain thesis. It's not just simply tulips, right? There is the actual returns, there have been the actual profitability, and there is the promise of all of these things. Whether they get delivered, that remains to be seen. Whether we're misreading the data, that remains to be seen. Whether those trends historically are really powerful and reasserted themselves, that also is a very real possibility. I am just raising the other side.
Or it's just as simple, and I know you make this point all the time, that everywhere else in the world is just really on the back foot.
True.
America's the only place to be.
Bottle that, though. Terrifying stuff. Coming up next on the programme, Lisa Shalett of Morgan Stanley, Bloomberg's Tyler Kendall, Anna Nikolayevsky of Axel Capital Management, and former St. Louis Fed President Jim Bullard in the second hour of Bloomberg Surveillance. Up next.
people are setting up for the potential for the Fed to sound hawkish?
We're not as optimistic as the market has been about further rate cuts here.
I think you may see a Powell that's a little bit more dovish than what the market's expecting.
In order to manage the soft landing, we need to keep easing monetary policy.
The labor market is stable if you look at the main features of it. That's going to put pressure on the Fed as it seeks this 2% target.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
The second hour of Bloomberg Surveillance starts right now. Equity futures on the S&P 500 up by 0.25%. Something in common with the people around the table complaining about their children as we start this hour. Equities right now on the Nasdaq 100 up by 0.25%. On the small caps, we're up by 0.5. Over the last few days, the last month in fact, every single trading day of December, we have traded with negative breadth. Will that change a little bit later on this afternoon? That's the equity picture. This afternoon, the main event, you know it, 2 p.m. Eastern Time. Chairman Powell makes a Federal Reserve interest rate decision, the final one of 2024, widely expected to be another interest rate cut. That's another 25, plus the previous 25 and the 50 back in September, 100 basis points of easing over the past 3 meetings.
Key question for me, a couple of them. First of all, how much does Jay Powell confirm what the market is expecting, which is a higher neutral rate for 2025? And does he push back against this idea that they would they would not welcome any material weakening in the labor market? Does he have that same level of conviction that basically this is a fragile labor market that needs to be sustained for a longer period of time? Or is there a bit more confidence in the heat underlying this market?
We just talked to Veronica Clark, and she's talking about the fact that we just don't know the makeup of these policies next year and how difficult that is going to be for the chairman, because he's going to be asked, what does immigration mean? What does tariffs mean? What does tax cuts mean? You already had a first iteration of Trump. You were deemed chairman during that iteration. So what can you tell us about what these policies might mean for the Fed decision making? It's going to be a very tough place today.
Expectations matter. I like what Veronica did just moments ago. When we talk about things being dovish or hawkish, you have to think about relative to what. So when we have the dot plot a little bit later, you compare that to September. Yes, we're expecting the median, to come down somewhat. But the bar to be hawkish compared to what we're priced for in 25, we're already looking for what, 2 cuts? In 2025, that's down from where the Federal Reserve was back in September. Can they even meet the market in today's meeting? That's a bigger question.
And maybe that's the reason why this is a Fed Chair Powell that always seems dovish, because he's not moving as quickly as the market is basically inferring that strength out into the future. So even if they do revise significantly their dot plot, how far does he have to go to actually edify what the market is saying? And if he does, how much does that spook the market and say, wait a second, maybe he's getting out over our skis?
That's the Lisa we know and love. Bearish once again. 3-part act a little bit later. Decision at 2 p.m. together with a summary of economic projections. You'll get the dot plot within that and all the forecasts. 30 minutes later, a news conference with Chairman Powell. Equity futures right now on the S&P 500 up by 0.25%. In the bond market, yields just about unchanged, up by almost a basis point. The 10-year through 440 this morning. And in foreign exchange, some stability in FX for the euro, just about 105 at 104.95. Coming up this hour, we'll catch up with Lisa Shalett of Morgan Stanley on why markets are losing the plot. Bloomberg's Tyler Kendall as the House releases a stopgap funding bill, and the former St. Louis Fed President Jim Bullard counting down to the final Fed decision of 2024. We begin this hour with stocks pushing higher, going into the Fed decision with a 1/4 point cut expected. The path forward is much, much murkier. Lisa Shalett of Morgan Stanley saying the implication of 2025 is that it will be tough for more cuts and disinflationary growth acceleration to both play out. We believe that growth will likely disappoint first and further Fed action will be constrained. Lisa joins us now for more. Lisa, it's good to see you.
It's great to see you, Jonathan.
Let's build on that. Why will further Fed action be constrained in 2025?
So our perspective is we're already seeing inflationary pressures build. Again, I know that the traditional economists among us like to, take apart the data to fit the narrative that they've assumed. But when we just look at the top line data, we've had 4 months of accelerating core CPI data, flat out. And that's with the advantage and the tailwind of a 20% drop in oil prices year over year. if in fact oil prices have bottomed out because global growth has bottomed out, and that if we assume that some of the cuts that have been put into the global system start to take effect in 2026, if we get a little bit of stimulus out of China, if oil starts coming back and we look at some of the dynamics in inflation, we could have very sticky inflation last year. I mean, this last print, you had goods prices up and food and grocery prices led the way.
Bigger, not hotter was a theme for 2024.
Yes.
You've referenced that in your note.
Yes.
Why do you think that changes? What underpins that change going into next year? Bigger and hotter?
Yeah, so, our sense is that animal spirits are real. Clearly, there's an enthusiasm and an expectation, that folks should be investing. But at the same time, our sense is that demand can outstrip supply here. We continue to have this have and have not economy where, the largest corporations, the richest households are somewhat, interest rate insensitive. And they've been powering consumption in this economy really for 2.5 to 3 years now. And the sentiment among those two cohorts is pretty strong right now.
So when you start to talk about this idea that we could see a downside to growth and that we could see more weakness than people expect with ongoing stickiness to inflation, I mean, that kind of sounds like dreaded stagflation.
Yes,
is that kind of where you're going with this?
It is. And it's one of the things, that we've kind of said is sequencing will matter. We expect that we're going to get a barrage, literally a machine gun of policy proposals, right? You guys, as journalists, are accustomed to the 10 headlines a day, and he tries to figure out, okay, which 4 stick of the 10, and then he goes with those 4 and another 6 the next day. Our best guess is that barrage is going to create a level of noise that does undermine some of that animal spirits and creates uncertainty for the other 60% of the economy, the low-end consumer, the smaller cap companies, because they can't figure it out. And so I think it's that we're going to see early in the year. There's an unbelievable, sense that, hey, consumers are going to get tax cuts. No, they're not. Not in 2025. Where it's going to be on a derivative basis, on the first and second derivative or the rates of change, right? Your taxes are going to be exactly the same in 2025, right? There's no tailwind, right? That's all coming in 2026.
And this is the reason why, in some ways, you're advocating to unwind some of the Trump trades that people have put on. Can you talk about which you think are most vulnerable to the reality check of sequencing, to the reality check of the delay of how long it will take to implement?
So look, I think that, some of these Trump trades have been so staggering, it's almost obvious. The cryptocurrency trades, up 50% in 50 trading days, extraordinary. We have, Tesla, similar type of move. I think some of the small cap move has begun to fade, in the last 10 days. Our best guess is that the fading of that small cap trade is what reflects this potential stagflation. That, hey, wait a minute, everything's great, but maybe it's not great for us, because we're still, broadly a set of unprofitable companies that have, struggled to deliver upside surprise in earnings.
So do you still like gold?
We still do like gold here, and for us, the gold story really is about inflation and dollar debasement. It's a lot about this debt and deficit story. Again, the bond market has sniffed out this joke. And on various days, you see, some folks trying to express a desire for term premium in the long end of the curve. Our best guess is, as these debates get underway, the debt and deficit storyline is going to have to,
so do you think
get higher profile.
We're at the peak dollar right now?
I don't know if we're probably close to peak dollar. But look, I think a lot of things are at play here. And one of the things that I think is a profound risk, again, this is not a market that's pricing many risks, But we have an extraordinarily bifurcated currency market around the world where the dollar is strong versus virtually every other currency. If, in fact, we come out, on day one after the inauguration and are extraordinarily aggressive with China, I think that there's a non-zero risk that China could come back and say, okay, we're devaluing. A devaluation of the renminbi would be hugely destabilizing across the global trade complex. And, those types of risks are just not being priced right here. So, is the dollar at peak strength? I'm not sure. But I think we're getting close, and we're just at this very fragile and unstable place.
If someone were to hear everything that you put together, they would say, wow, what a raging bear. Oh, my God, you must be predicting 4,200 for next year.
No, not at all.
OK, so let's talk about why not, because basically you're talking about debasement of the dollar and the end of the Trump trade and stagflation. So give us where you really are with this.
So look, I think that there are risks out there that we want to see priced. At the same time, there is value because this is an extraordinarily bifurcated market. So we're saying that this is going to be an environment where there are winners and losers. So we do see some winners, right? So we see financials, we see domestic industrials, we see portions of consumer services that, again, are domestically based as big winners here. We recently upgraded mid-cap growth companies as areas. We've built some diversification. We're owning, Japan. We're owning some parts of emerging markets. So we think that there are things to do out there. We think that this is a index that next year can chug along at the index level and maybe give you 5 to 7%. But at the same time, what we're saying is if you're getting 5 to 7% in a stock market that is extraordinarily richly priced on extraordinarily ambitious expectations, why not own a better risk-adjusted return in an investment-grade bond and clip the coupe and just, make it to the end of the year?
You mentioned EM. What do you like in EM? Which parts?
So we've been long bulls on India. We know India has stalled out. We think Mexico is way oversold, and that by the end of the year, we're going to find a better footing there, and some of the tensions with the U.S. Will be mitigated. Brazil, obviously, now significantly tightening. We believe that that's going to get priced and that there's going to be opportunities, to buy some value in Brazil.
I've got the foreign exchange screen in front of me. Year-to-date emerging markets. It's amazing. The peso in Mexico down 16%. In Brazil, the currency down by more than 20%. Likewise in Argentina, go up to Russia, down 13%. In Hungary, down 11%. Colombia, down 11%. Double-digit moves in foreign exchange in EM.
You have to wonder at what point you hit sort of a bottom, given the fact that you have a lot of potential trade wars being priced in.
Lisa Shalett, it's good to see you, as
Great
always.
to see you.
Appreciate your time. Thank you.
Thank you.
Lisa Shalett there of Morgan Stanley. Equities this morning on the S&P 500 at the moment, near session highs, up a third of 1%. With an update on stories elsewhere, here's your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. Scott Bassett, Trump's pick to run the Treasury Department will meet with Democratic Senator and frequent Wall Street critic Elizabeth Warren today. It's part of a series of meetings he's having on Capitol Hill ahead of his confirmation hearings next month. He will meet with several Republican and Democratic senators today, including outgoing Majority Leader Mitch McConnell, Texas Senator Ted Cruz, and Oklahoma Senator James Lankford. The head of Tesla's China factory is leaving the company, according to people familiar with the matter. Song Gang, who oversaw construction of the company's Shanghai factory, will leave this week. Song joined Tesla in 2018 as the first employee of the EV maker's first factory outside the U.S. And the Milwaukee Bucks are the 2024 NBA Cup champions. The Bucks defeating the Oklahoma City Thunder 97-81 in the championship game, led by an MVP performance from their superstar Giannis Antetokounmpo, who finished with 26 points along with 19 rebounds and 10 assists. The Bucks bounced back to win all 7 of the tournament's games after starting the season 2-8. That's your Bloomberg Brief. John?
Yahara, thank you. Is anyone watching this anymore? NBA, basketball?
Okay.
I think the WNBA took the oxygen out of the room.
That's your argument?
That's my argument. I think Caitlin Clark
Caitlin
single-handedly.
Clark, yeah, remember those tickets were so high that people were preferred to go see her play than some of the men?
That's my take.
Okay, I'll
and
take that theory. I'm happy to move on without challenging it. Up next on the programme, avoiding a shutdown for now.
We worked really hard to achieve consensus on a bill that responsibly funds the government into March of next year. We ought to try to pass this on a rule to go through regular process. We're committed to all of that. We're going to take care of these obligations and get this done.
That conversation up next. Live from New York this morning. Good morning. Snapshot of the price action right now. Equities at the moment up by about 1/3 of 1% on the S&P. On the Nasdaq, up by 1/3 also. On a Russell, up by 0.6. Big focus on the breadth of the S&P 500. How many stocks are advancing versus how many stocks are declining? You mentioned Jim Reed of Deutsche Bank a little bit earlier this morning. Jim Reed noting the 12th day in a row where the number of decliners exceeded advancers within the S&P 500. Lisa, he's made the point that this is the second longest run in 100 years and has only been exceeded by a run of 14 days back in 1978.
It's pretty shocking to think, what does this mean? Normally when you get narrow breadth, it makes people nervous because what that means is only a couple stocks are holding up the entire index. Lisa Shalett was talking about how small caps rolling over indicates that fear of potential weakening growth. On the flip side, you could say it just indicates the strength and the preeminence of a number of names that are fundamentally changing the landscape for technology.
So should you be worried? Jonathan Krinsky of BTIG saying the breadth collapse has not been confirmed by credit spreads. Over this period, credit spreads have been tightening. They've not been widening. So is there something to worry about for the broader economy? The credit market, for at least for now, says no.
And basically, a number of the notes that I was reading, and honestly, we've been hearing this from a number of different investors. If anything, it sets up for a buying opportunity next year. And that's essentially what we heard from Julian and Emanuel earlier, that essentially this is just selling the news and then resetting before an early 2025.
I mentioned credit. Let's turn to fixed income just briefly. Take a look at the Treasury curve, 2-year, 10-year, 30-year. Yields a bit higher this morning by a single basis point on a 10-year. Let's call it 440.66. Under surveillance this morning, avoiding a shutdown for now.
We worked really hard to achieve consensus on a bill that responsibly funds the government into March of next year. We've been working around the clock to get the CR done. It was intended to be, and it was until recent days, a very simple, very clean CR, stopgap funding measure to get us into next year. We ought to try to pass this on a rule to go through regular process. We're committed to all of that. We're going to take care of these obligations and get this done.
So here's the latest this morning. Congressional leaders reaching a deal to avoid a government shutdown with a stopgap bill set to extend funding through mid-March. House Speaker Mike Johnson bracing for pushback from House Republicans with the bill's disaster aid funds totaling over $100 billion, opening the door for further infighting. Joining us now from the nation's capital, Bloomberg's Tyler Kendall. Tyler, how much opposition does this stopgap bill have in Washington, D.C.?
Yeah, good morning, John. I was actually on Capitol Hill yesterday where we felt that growing discontent among Republicans when it came to this stopgap measure, despite their leader, House Speaker Mike Johnson, being the one to negotiate it. And I spoke to one senior Republican aide for a member of Congress that we are expecting not to vote for this bill, who said that it's mainly the lack of pay-fors for this additional supplemental funding that is tacked onto this bill that is the largest sticking point. Now, you mentioned there, perhaps most notably, the $100 billion in disaster relief funding for Americans that are still reeling from the devastating hurricanes that happened over the fall in the southeast U.S. Of course, that was part of a bipartisan push. President Biden had asked for that money back in October, but we're seeing a litany of other issues be tacked onto this bill, including $10 billion in economic assistance for farmers, even potential curbs to U.S. investment in China. And in one interesting move, the bill actually paves the way for the Washington Commanders football team to relocate their stadium from Maryland back to the nation's capital. So the bill is anything but a clean CR that you heard House Speaker Mike Johnson say was their original intent. Now, despite that, we are widely expecting this bill to pass. They don't want to stay here past that Christmas holiday or set up a government funding fight right ahead of the inauguration. But it does do two things. It likely sets up a government funding fight just months into President-elect Trump's new term, particularly as Republicans try to cut back on what they are calling bloating spending. But before any of that happens, it also poses a potential challenge to House Speaker Mike Johnson, who's campaigning for the gavel again, and that will happen on January 3rd.
Tyler, Elon Musk doesn't like this, and he's making that very clear on Twitter this morning, saying it shouldn't pass, and then he's posting a photo of how big the bill it is, this monstrosity. You're hearing people say Merry Christmas, everyone's getting a stocking stuffer in this bill. Do you think he has real weight when it comes to whether or not this passes?
Right, of course. Well, we do know, as you've been reporting, he's going to head up the Department of Government Efficiency, which will look to cut some of this bloated government spending. But we are heading to likely another battle next year as the Trump administration lays out its priorities that likely will actually add to the deficit, including his proposals for tax cuts next year. One Bloomberg analysis showing us that if all of his tax cuts are passed, it could add $10.5 trillion to the deficit, besides some of the positive economic benefits that his administration is hoping to push through and convince Republicans in a unified government to pass. Now, when it comes to Elon Musk, we do know, of course, that he has been advising President-elect Trump, and that as many of these CEOs head down to Mar-a-Lago to meet with him, this is going to be one of those issues that comes up, how corporate spending, government spending is all going to be intertwined in a new Trump administration.
Well, when we looked ahead to 2025, we still have a number of Trump nominees on Capitol Hill, meeting with senators. Interesting enough, Scott Bessent, his Treasury pick, is going to be sitting down today with Elizabeth Warren, and she hasn't been too warm and welcoming of him thus far. How testy could this exchange get?
Right, Amory, you had that great reporting this morning on the terminal that meeting's going to happen. Of course, importantly, Senator Elizabeth Warren is going to be the ranking member on Senate banking next year. And as somebody who has interviewed Senator Warren dozens of times on Capitol Hill, of course, she is known as one of the biggest foes of Wall Street. But also, I'm kind of interested to see if maybe there is any common ground here. For example, we know that she has worked with at least one member of the incoming Trump administration, and that's now Vice President-elect J.D. Vance, when he was a senator on Senate banking. The pair teamed up on that executive clawback compensation bill in the event of a bank failure. So that could be one potential area that perhaps she could see her more populist message break through. But as your reporting showed, this is likely to be particularly contentious, and of course comes on a day of a big Fed decision. And we know Elizabeth Warren herself has proclaimed herself a foe of Jerome Powell's.
Tyler, you've been making the commute from Washington, D.C. to Mar-a-Lago. How crowded are the planes from D.C. to Mar-a-Lago?
Right, we're seeing everybody flock there. Of course, we have the reporting that most of these CEOs, including Jeff Bezos today, will be heading down to Mar-a-Lago. But it extends beyond that. Other names like Mark Zuckerberg and also Sundar Pichai, Tim Cook, all in the last week going down there to meet with President-elect Trump. And I was talking to actually one Republican strategist about this who said it's actually it's a pretty good operating procedure, right? Since we know that President-elect Trump often will reverse course when it comes to his critics if they're willing to cut a deal and perhaps give him a political win. All of these CEOs, for the most part, have shown some sort of criticism or perhaps didn't outright endorse his campaign. And we're sort of seeing a pattern emerge from these meetings, right? One, of course, is that they're going down and they're having this FaceTime in person. That appears to be absolutely critical. They're not doing this over the phone. And the second appears to be donating to his inaugural fund, using that money as a commodity to show their support in that way. I was actually interested by this. Just quickly, we know, of course, the Amazon CEO, Jeff Bezos, going down there. Amazon has pledged $1 million to Trump's inaugural fund. I looked up the FEC filings from last inauguration. At the time, Amazon gave about a quarter of that to Joe Biden's inaugural fund, $276,000. That seems to be underscoring this point that there is going to be a unified government in Washington next year. It's not just Trump one, but that there's going to be more policymaking with Republicans controlling both chambers of Congress.
Tyler, that's Bidenflation. That's what that is. Tyler Kendall, down in Washington, D.C. Appreciate it. Tyler, thank you. This came from John Carney, the team over at Breitbart. Looking forward to the reaction from Mar-a-Lago to what happens at the Federal Reserve. Trump world fears Fed cuts may stoke renewed inflation.
That is interesting. So basically, this idea that maybe Kevin Warsh's hawkishness will be welcome.
Let's see what we get from New York. This is Bloomberg. Equity futures this morning positive across the board on the S&P 500, the Nasdaq and the Russell. Equity futures on the S&P near session highs up by about 0.25%. Likewise on the Nasdaq, some outperformance on the small caps on the Russell, up by 0.66. With 2 hours until the cash open, let's get you some morning movers with Manus Cranny. Good morning, Manus.
Jonathan, good morning. Every nation likes to create their own national champion, just in different forms at different times. This time we're talking about Japan. This is the ADR for Nissan. Honda, we understand, pursuing a merger. Certainly not going to be a merger of equals. Honda worth $44 billion, Nissan worth $8 billion, with $1.6 billion worth of bonds to recapitalize next year. But this is about the pursuit of financial expediency, political expediency, and how to survive in the world of electric vehicles coming from China. Some of the reporting is Nissan senior officials saying we're fighting for our lives, 12 to 14 months to survive. Either way, you've got a maturity wall, as I say, of around $1.6 billion. This is about the politics of survival of your auto industry on the world stage. That's what you're seeing writ large here. By the way, Honda is down just over 3% in the ADRs. We wait for the ADR print to come through in the US. Nvidia is bid this morning. Again, lovely story. Microsoft reaffirming the narrative that Microsoft does scoop up Nvidia chips in size and in quantum, 485,000 of them to be very precise. The next biggest order on the ticket dock is Meta at 224,000. This is all from Omdia collating the data on that. So a little bit of a reprieve for Nvidia. General Mills, you get your Haagen-Dazs, you get your Lucky Charms, you can get your Nature Valley bars. They have lowered their guidance for the year. Why? Because of the uncertain macroeconomic backdrop. I'd love to be a PR person to write these things. Uncertain macroeconomic backdrop, higher investment levels. I mean, bottom line is they're holding up in North America, but it is a fairly defensive sector to be in. To try and win market share in this area is proving tougher and tougher. Jonathan,
are you a Nature Valley bar kind of guy, Manus?
That is a bar of sugar, and you know that that's banned.
Carbs free.
Carbs free.
Manus, I know, I get it. He's not a Nature Valley kind of guy.
He's a big carbs-free guy. I think I introduced him to even what Trix was because they started putting them upstairs in the pantry.
I remember back in London, this is a long, long time ago, and the show would begin at like 6 a.m. London time, and you'd start to smell fish coming from the set because he would eat fish before the start
or
of the
grilled
show.
chicken because no carbs.
Yes, no carbs.
Okay.
He would eat fish.
He hasn't seen a carb since the 80s.
All I can say is you guys took that somewhere so different. I didn't even realize Haagen-Dazs was General Mills. And I love Haagen-Dazs. So I'm just going straight for the junk as you guys go toward the purity test of, the nature,
some people
Valley
might
nature.
consider Nature Valley to be
Nature Valley?
Junk, too.
I just embrace Haagen-Dazs, which is actually really good
different
quality.
story.
I like it.
I wanted to get to this story because I know it's your favourite.
It's my favourite for that.
The quote of the week so far. Under surveillance this morning. Canadian Prime Minister Justin Trudeau attempting to downplay the resignation of his finance minister. Trudeau telling a Liberal Party gathering, quote, wait for this, like most families, sometimes we have fights around the holidays. But of course, like most families, we find our way through it. I love you guys, and love is what families are all about.
I can't even.
It's better when you see the video, and hopefully you can find the tape a little bit later, but honestly, ridiculous.
Honestly, it's fantastic. And I got to say, kudos to the Bloomberg News headline writer as Trudeau tries to brush off Deputy's exit as festive family spot. This isn't going to win him any points with the electorate, who are probably going to vote him out of office, considering the fact that everybody can see that she was frustrated with him. She didn't want to release her budget. It was the day she was supposed to release her budget, and she quit because she didn't agree with him.
Not just the electorate in Canada, his own party, the number of lawmakers and the Liberal lawmakers calling for his resignation has grown to 45, with one saying he's delusional. I was speaking to Josh Wingrove yesterday, who's our resident expert Canadian, works in the White House team, and he said, I was trying to explain it to people in America how big of a deal that this finance minister decided to resign on that day and the scathing letter she wrote. He said it would be basically, you would have to imagine Kamala Harris coming out and resigning the day Joe Biden was giving his State of the Union. That's how seismic of a shift this was.
It's really well framed and couldn't agree more. More on Canada a little bit later. Let's turn to Uber. Uber joining the list of tech firms donating to President-elect Donald Trump's inauguration fund. The rideshare giant and its CEO, Dara Khosrowshahi, each donating $1 million alongside the likes of Meta and Amazon. According to CNN, Trump is set to meet with Amazon's Jeff Bezos a little bit later on today.
So the better question to ask is, who isn't donating? Because everyone is going to be donating to the inaugural fund. What we are just hearing about are companies that are willing to come out and say, yeah, you should put my name out there that I also gave $1 million. Industry-wide, the list is very long, and we just really are hearing about the tech world. But it'll be interesting to see what banks are donating and what other companies are also making sure that the president-elect knows that they're giving to his inauguration.
This is the question I have for you. What's this money going to go toward? Is it going to be just some kind of spectacular? Will there be just
inaugurations are expensive?
Well, okay, but I want to know, what is this spectacle and how significant it's going to be? Because I think that kind of sets up.
Lots of parties, lots of security. I will come back with a list for you on potentially exactly what they are going to be budgeting for with this money. Thank you.
Does Doge itemize that list for us?
Doge.
To get a breakdown.
I mean, if they're trying to Dogify the government, maybe they should pull back.
Dogify the inauguration.
Yeah, Dogify the inauguration.
Let's turn to this one. The Defense Department saying the mysterious drones sighted across the Northeast are not being flown by the Pentagon. Major General Pat Ryder saying officials take seriously any cases of drones flying near military sites, but adding they aren't a concern given the volume of daily drone flights.
This is not comforting to me. It's sort of like a game of charades where it's not from the Pentagon. Is it from the Army? It's not from the Army. I mean, basically, why don't you tell us rather than signaling what it potentially could be? There seems to be an explanation that some of the authorities just don't really want to share.
Well, when we heard from General Ryder, he said it is possible that some of those are surveilling, absolutely, but you can make the assumption in every case, not necessarily. So again, left me with more questions than answers. PG&E, I thought was fascinating, though, the CEO this morning saying how many drones they have to make sure that they're looking after their infrastructure. And you can imagine a lot of companies are doing that. But if the U.S. government has the information, just tell people, because people are starting to talk about that they want to get these drones out of the sky themselves, and people should not be taking these type of measures into their own hands.
Yeah, that's not what we want to see. I think we want some answers quickly going into the weekend. Let's get you some stock news. Micron reporting after the closing bell, the chip maker looking to be the latest firm to benefit from the surge in AI demand. Anna Nikolayevsky is the founder and CIO of long-short firm Axel Capital Management and has been betting on the name since 2023. I'm pleased to say that Anna's with us now. Anna, good morning.
Good morning. How are you? Thank you for having me.
It's been a great year for some chip makers, but not all.
True.
It depends what you're exposed to, PC, smartphone, data centers. When we talk about Micron, what kind of exposure are we talking about?
I think at the moment people are expecting the quarter to have up ASPs in the 5% range. I think the ASPs going forward may actually be flat to down, and you're probably not going to see a recovery until the back half of 2025 because there's going to be a little bit of a push out for smartphones and PCs at the moment.
What is it about the back end of 25 where you start to get a better tailwind for those kind of businesses?
There's going to be a replacement cycle.
Across smartphones?
Across smartphones and PCs. I think at the moment you are not seeing 100% adoption by the consumer of AI PCs. I think Best Buy has hired several thousands of people to help train consumers on the AI PCs, but there's no major uptake right now for the Christmas season, as far as I'm hearing. So there may be an uptick later on next year when there's a natural upgrade cycle for enterprise and consumer.
What's fascinating to me is that people have been trying to pick the next NVIDIA, the next big winner from the whole chip cycle, and the fact that we've seen some real massive winners. Broadcom seems to be the latest superstar. We've just seen this moonshot in the shares, with them falling right behind Tesla as sort of the Magnificent Eight, and people are playing around with what the name could be. What gives you confidence that Micron's growth has that type of moonshot at a time where people are trying to imagine what the sort of evolution of AI adoption looks like?
I think when I think of Micron, I think of DRAM, I think of a global commodity that is actually going to be benefiting from some of the U.S. chip stimulus. But I think long term, you're going to see more and more DRAM across the board, and everything memory is extremely important. So I think about Micron in terms of that long-term cycle that right now probably is going to decline a little bit, but will come back up again later. Although last year, Micron was telling us that 2025 will be the peak. So it's a function of what overall tech adoption will be like in terms of hardware.
When you talk about your investments, you're investing on the tech side with Micron, but you're also very low tech with respect to just what people buy every day. Maybe some of the Nature Valley bars that some people like, and Haagen-Dazs that some people like and enjoy.
Is that a staple?
Actually, in our household, it is a staple, and we go
For
through
many
a lot
households
of
across
cars.
the United States of America.
And that's okay.
That's what they want to hear.
Some people grow up with Lucky Charms and turn out just fine. But I will just say, Anna, how much are you really going towards some of these staples, and why now?
We've taken a very conservative approach to investing right now, where we have large holdings in BJ, in Costco, in Walmart, across the board. One of the reasons for that is we're trying to go to where the puck is going. And at the moment, we're seeing a slowdown in AI adoption. I think we're seeing the opposite of the FOMO that we saw in the beginning of last year, where managements were virtually throwing money at GPUs. It was all about speed and scale. And this year, I think we've seen a significant transition in terms of how are you going to monetize this AI? What is it going to cost? What is the must-have app? And what is it going to cost on a long-run basis to operate the AI once you get past the training part?
But these names, Costco, Walmart, Target, it's where you can find good deals.
Precisely.
Do you see a slowdown in the consumer?
I think we're seeing a slowdown in the consumer already. I went to buy some coffee the other day, and a pack of 20 Starbucks K-Cups cost me $40. So I think that everyone's kind of migrating towards cost saving, but I'm literally thinking about what's going to happen to the S&P if there is a slowdown in tech. Where will that money migrate? And to me, the money is going to migrate towards more conservative, stable cash flow generating areas of the market. That being said, I think that Trump is 100% pro the market, and he's surrounded by extremely smart people. I think very highly of Scott Bessent. I think Elon Musk is one of the greatest innovators, just beyond this generation, obviously, maybe of all time. So I'm very impressed by the team that he's assembled. But that being said, I think that technology is on a cycle of its own, and we're seeing changes in terms of focus ROI. We're looking at intellectual property and security issues to consider, and also in terms of AI data governance also needs to be addressed.
You've been super gracious with your time already this morning, but this is not the reason you're with us. You're with us because you're participating in the Robinhood stock picking contest, whereby you have to pick one long and one short and see who wins over 6 months. We can put the leaderboard up on the screen. Can you share with us your long and short and what's behind each one of those picks?
So my long is BJ, just primarily generates a lot of cash flow. And I think that if GDP does slow down, I think the stock will be pretty resilient. My short is in technology. As I said, I think you're going to see a slowdown. I think right now, when you're looking at prices of GPU rentals, they've come down pretty considerably because there's a lot of server optimization. And once you've stopped trying to train your AI, you may have excess GPUs that now you're starting to re-rent to other people. So now it looks like there's a lot more competition on the GPU rental front. So longer term, that's extremely positive because it's going to lower the barriers to entry for new companies to come to train and create new business models. But in the short term, that may create some pressure for data centers and the chip manufacturers.
That is fascinating to me. How much do you think that is underappreciated right now? I mean, that sort of speaks to the short position. Why do you think that's overlooked?
I think the CEO of Microsoft mentioned it last week when he said there's no longer a chip shortage. I think we were chip constrained for 18 months, but I think that started to resolve itself probably in the middle of this year. And now I think volumes are coming to the market, and you're seeing a large reseller market. You're seeing supply come onto eBay and Alibaba of entire GPU clusters, which is going to depress pricing.
And it's all for a worthy cause, so it's good to see you. And thank you for sharing that with us.
Much.
Thank you very much. That was Anna Nikolayevsky there of Axel Capital Management. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara Hacker. Say, Yahara.
Hi, John. Staying on chips, the U.S. is set to be gearing up to initiate a trade investigation into Chinese semiconductors in the coming days. Sources say the review could result in tariffs or other measures to restrict imports on older model chips and the products containing them, such as cars or smartphones. The investigation could take months to conclude, with any reaction left to Donald Trump's incoming administration. Meanwhile, President-elect Donald Trump has chosen football legend Herschel Walker to be ambassador to the Bahamas. Trump made the announcement in a post on his Truth Social. Walker most recently had an unsuccessful run for a Senate seat in Georgia. To hold the ambassador position, Walker will need his nomination approved by the Republican-led Senate. And struggling automaker Nissan is in merger talks with Honda. The deal would create the world's third largest automaker. Talks between the two companies accelerated after iPhone producer Foxconn approached Nissan to take a stake. Nissan's troubles came to the forefront this year after the company slashed its profit forecast and revealed plans to cut 9,000 jobs globally. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in about 30 minutes' time. Up next on the program, the Fed bracing for Trump.
We don't know what the timing and substance of any policy changes will be. We don't guess, we don't speculate, and we don't assume.
We don't guess, we don't speculate, and we don't assume. I imagine you might hear that again a little bit later on this afternoon. From New York, this is Bloomberg. House Speaker Mike Johnson making some comments to an American broadcaster just moments ago, Fox News, saying that Elon, Vivek and I are in a text chain together as the House and Congress looks to pass a stopgap funding bill through the end of the year and into 2025.
So two things. They're basically like us. John, Lisa, myself are in a text exchange. But also, why is Elon Musk then going to Twitter saying, I don't agree with this bill? Speaker Johnson needs this bill to pass. Maybe just tell him first in your WhatsApp or Signal group chat.
But the three of us aren't passing quadrillion-dollar bills, are we?
No, definitely not.
And one of you is not the Speaker of the House.
What
I mean,
kind
maybe one of you will be in the future. I've got no idea.
What kind of emojis do you think they use?
Lots of robots.
I don't want to know.
Robots, for sure, and American flags. Definitely the top two.
Probably. What do they think about this bill? I think we're already getting a sense of that Elon Musk doesn't really think much of it.
No, he thinks he's trying to Dogify the government, so he doesn't want to see this Christmas tree bill where a lot of money is being thrown at it, including pay rises for lawmakers.
It's very difficult to change the ways of Washington. Really, really hard, and we're going to see that play out over the next few weeks, I'm sure. Equity futures right now on the S&P 500 positive by 1/3%. It's Fed decision day. In the bond market, yields are up by a basis point or two. The 10-year 4.41. Under surveillance this morning, the Fed bracing for Donald Trump.
We don't know what the timing and substance of any policy changes will be. We therefore don't know what the effects on the economy would be, specifically whether and to what extent those policies would matter for the achievement of our goal variables, maximum employment and price stability. We don't guess, we don't speculate, and we don't assume.
So here's the latest this morning. The Fed expected to announce its final interest rate decision of the year and deliver its latest summary of economic projections ahead of a very uncertain political future. Joining us now to speculate, to guess, to assume is the former St. Louis Fed President, Jim Bullard. Jim, welcome to the program, buddy. It's good to see you. Can you speculate on next year? You've lived it. You were on the FOMC for the first Trump term. How different is this second term, Jim?
Well, I think it's a big advantage that we have seen this movie before, and so the first time around it was more uncertain. I think this time you kind of know the MO for President-elect Trump, how he operates, the kinds of things that he'll consider most important. And I think for markets, it's basically a pro-business administration, and that carries a lot of weight.
Meanwhile, Jim, we're talking about the potential for signaling into next year. How far do you think that this Fed chair is willing to go at a time where the market really has pretty low expectations for how many rate cuts are next year? Can he or does he want to get ahead of them and signal a potentially even more restrictive stance?
Yeah, I think the dot plot is going to do the job for the Fed here. And the dot plot is, Wall Street either thinks 3 or maybe 2 is a median number of rate cuts for next year. Those will be spread out over the year. So that's going to dovetail with the story that much slower pace of rate reduction. They've come on with this meeting. They will have come 100 basis points in just 3 meetings. It's going to be nothing like that next year. And I think it'll set up a clear case for pause, high probability of pause in January. And that'll give them the March meeting, and that they can sort of look around at the March meeting and see if they want to go further or not. And that will depend mostly on the inflation data at that point.
Jim, do you think that they are concerned about the fact that since they cut by 50 basis points, we've seen a steadying out and actually an increase in longer-term yields, the sense that maybe inflation is going to be stickier next year? If you were still on the Fed, would that concern you?
Yeah, I maybe have a different view as always, but I think that the normalization of the yield curve, that 2 years less than the 10-year now, is the last piece of the soft landing story. And so I think this is exactly what you would want to see if you had a successful soft landing. You've got growth, I guess Atlanta Fed GDP now over 3% for the fourth quarter. You've got unemployment close to the natural rate by most people's estimates. You've got inflation way down from its peak and above 2, but trending toward 2 in 25 and 26. Normalization of the yield curve is the last piece of that. So I think it's all very healthy in my view.
Jim, I'm sure you won't mind me saying this, but many years ago you made a mockery of the dot plot at the Federal Reserve by planting your dot at the very bottom all the way out. Now, Jim, I just wonder if you had a dot today, how different that dot might be. Think about the long dot. How much do you think is going to change over the next few months relative to what we've seen over the past few years? Does that long dot need to keep coming up?
Yeah, I think it is going to come up a little bit more. I think the committee's been more bullish. I didn't like the long dot part of the dot plot because that's the thing you're most uncertain about, and it kind of anchors everybody's thinking. So. And I think what happened during 2009 to 2019 is that you were in this low real interest rate, low nominal interest rate, low inflation regime. And the pandemic was big enough to knock us out of that regime globally. And now you're back to something closer to the 2000 to 2007 period, or my favorite period, the late 1990s. And so the real rates are higher. So I think that's pushing up the whole interest rate structure, and I think that's what we're going to be looking at over the next 5 years.
Jim, there's a common theme on the FOMC. The only difference I see is in degree, not in kind. They'll say things like, we're a long way from neutral, so we can keep making a move here. Jim, when they say things like that, what's guiding their view on how far away they are from neutral?
Yeah, and the median of the committee thinks neutral. The neutral Fed funds rate or the neutral policy rate is 3%. And you need about, depending on how you calculate it, another 100 basis points on top of that to combat the fact that inflation is still above target. So that gives you 4% as a ballpark. And of course, there are opinions around that, higher or lower. But where the committee is today, coming into this meeting, is too high for that. So that's why they feel they've got comfort in making this move today. And then they'll be able to sort of get some more data over the next 90 days and see what to do next. But they feel pretty comfortable, I think. And I'd be comfortable making this move today.
Jim, making the dot plot great again. It's good to see you, sir. Enjoy the holidays. Jim Bullard there, the former St. Louis Fed president. Can we close that gap between where the Fed is on neutral and where the market is?
Stop reading my mind. That's what I was going to say. Make the dot plot great again. That's essentially what we're looking at here.
Do you remember what Jim did all those years ago?
What? Yeah, I do.
love that.
I love that too.
Putting the dot right at the bottom, just making a mockery of the whole thing.
But he's fallen back in love with it.
But he was right back then to do what he did. We kept projecting higher interest rates, going back to where we were before, and it wasn't happening.
Now it's
until the pandemic.
Yeah, and then it shook us out of that.
Things changed again. Up next, we'll catch up with Victoria Fernandez of Crossmark Global Investments, Greg Peters of PG&E, Jonathan Pingle of UBS, Priya Misra of JPMorgan. The third hour of Bloomberg Surveillance just around the corner.
We don't quite know what's happening in the US economy, and that's something that other central banks are looking at.
The US exceptionalism story, we think, still has some legs.
I think that America has still got a very good narrative.
There's just no interest for anything except the US.
For the moment, US exceptionalism is a story that's really, really hard to push back on.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
90 minutes away from the opening bell. The third hour of Bloomberg Surveillance starts right now. The snapshot of the price action looks like this. Some outperformance on the small caps. The Russell up by 0.9%. Run away this morning. Equity futures elsewhere on the S&P up by a third. On the Nasdaq 100 up by a quarter. Big story of the month so far, the negative breadth 12 days of it, Bramo. It's been pretty bad under the surface.
Yeah, and as you mentioned, Deutsche Bank noting that this was the second time that's happened in the past 100 years. A key question here is whether this is just a pause, a retrenchment after the broadening out, the Trump trade, or whether this is the beginning of a reassertion of big tech in leadership yet again at a time where there are pockets of weakness under the hood.
That's the performance going into the Fed decision later on this afternoon, 2 p.m. Eastern time for that call. Then the projections drop at the same time. 30 minutes later, a news conference with Chairman Powell. There is a handful of economists today who don't think the Federal Reserve can interest rates. Two of them, friends of this program, Stephanie Roth, Wolf Research, and another Drew Mattis from MetLife. Two that think this Fed might stay on hold.
Pause. There is a question about what the Fed should do.
Unpaused. How much longer?
Okay, we can start again. But meanwhile, I just think that there's a sense that the Fed should consider maybe not cutting 25 basis points based on the fact that you're seeing this incredible dynamism and a number of record highs and no sign that there's really restrictive financing conditions. At the same time, why would they surprise the market when they have been saying repeatedly that they're far away from neutral, especially when they are setting up for some sort of pause? They don't like to surprise the market, and it seems like that's likely again today.
I think what it speaks to, though, is potentially what we will see on the FOMC is that some individuals are going to come out and say, maybe we shouldn't be cutting. And we know Jerome Powell, it's like herding cats. He wants to speak with one voice when it comes to the Fed, and potentially he's not going to have the backing of everyone when he comes out and greets the press.
The overwhelming consensus is that they cut interest rates today, and then they skip in January. But we'll see what we get. We'll see what we get in January as well, because so much of this for 2025 comes down to changes to policy in your world, Anne-Marie. Lisa, whatever happens in Washington will dictate a lot of things we talk about through the next year and beyond.
And that's the reason why some people are looking for scenario analysis, which they're not going to give. They're going to say we're just completely dependent on the data that comes in and the policies that come out. Interesting, though, to see where the emphasis is. I'm sure that there will be questions about what the most inflationary potential policies are, whether it's tariffs, whether it's immigration, and potentially some of the restrictions there. Again, more scenario analysis, so get ready for a lot of that this
Just
afternoon.
get the script out. We don't guess. We don't speculate. We don't assume.
Yeah, but he can't do that for everything.
On repeat.
Yeah, I don't know.
Oh, he could, but it'll be boring. So I hope not.
That'll be the news conference later. Tune in. 2:30 Eastern Time. Coming up, Victoria Fernandez of Crossmark looking ahead to the Federal Reserve. Greg Peters of PGIM on why the FOMC can meet its 2% inflation target. Priya Misra of JPMorgan on why she's expecting 3 rate cuts next year. We begin this hour with stocks higher ahead of the final Fed decision of the year. Victoria Fernandez of Crossmark saying the problem is that both sides of the dual mandate are heating up. The question comes down to, is the Fed still restrictive? And according to Powell, the answer is yes. Victoria joins us now for more. What's the answer according to you?
I don't think we're as restrictive as the Fed wants us to believe. I mean, you look at growth. You've got Atlanta Fed GDP now, 3.3%. You've got inflation. We had CPI and PPI reports come out. Big revisions there, inflation being sticky. And you have really high sentiment right now. Look at NFIB, small business, 3-year high on sentiment. You've got bull-bear ratios. Very strong on the bulls. Now, that can be a contrarian signal. I get that. But you still have really strong sentiment that is out there with these elements. I don't know how you can say this economy feels restrictive. I say, yes, there are underlying elements, right, under the surface that I think will start bubbling up, but I don't think it will be until early next year.
But isn't that disconnect just super bullish? So long as the Federal Reserve Chair thinks they're restrictive and keeps cutting interest rates, isn't that just a green light just to keep on buying?
It is for now, and I think that's why you're seeing the market continue to move up. Yes, the past few days we've had a little bit more volatility in play, but the market is going, and you've got the seasonality along with it. You've got earnings expectations that people think, I think a little optimistic, but double-digit growth again next year in earnings. You're not having the labor market completely fall apart. So I do think there's elements that are tailwinds to this economy, and you add Powell in, which I know you said you think it'll be boring, Anne-Marie, but I do think he's going to come out and say the same. We're data dependent, recalibration, blah, 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 and everyone's just going to look to the dot plot, regardless of what Jim Bullard said earlier. They're going to look to that dot plot and go, what are you really thinking?
I don't think it's going to be boring. I think it's going to be fascinating, and I cannot wait for the meeting and the dot plot and the press conference afterwards, in particular, because as you're saying, this is a tailwind, essentially the idea of a Fed cutting. There is a question of for what assets? Is it a tailwind for stocks? Is it a tailwind for bonds at a time where you have a real discussion, longer term, about whether this actually increases the chance of stickier inflation over 2025 and 2026? What do you expect to be the reaction in the bond market, particularly at the longer end, should this be a Fed that does lean more dovish than, say, what the market is expecting?
Yeah, if you get a more dovish feel to the press conference, I do think you'll have equity markets rally a little bit, and bond yields will probably come down, at least in the near term. I think they come down a little bit with the expectation that the Fed will continue to cut. However, bond vigilantes are not going to be happy with that. So let's give it a little bit of time. I think they'll come in, they'll start singing, and we'll see yields move up intermediate term from there. But the initial reaction, if the Fed is dovish, I think you'll see yields come down a little bit.
That raises this question about whether the market does not believe inflation to actually be a real threat. I mean, which is it? It seems like there are different messages from different asset classes. In the bond market, it seems like there isn't a great deal of concern, but it's definitely a sense that things are stickier. And then the stock market, they're just saying, we don't care. If it's mildly inflationary, that's great. Let's go.
Right. And there's other elements that could cause inflation to go higher. It's why it's such a difficult story right now. I mean, we don't know what tariffs are going to do exactly. We don't know what kind of corporate tax cuts or individual tax cuts are coming in, and is that going to be inflationary? I think the key to a lot of this, though, is productivity. That can really be the element that comes in and buffers inflation and helps growth move higher. So if the expectation is that you're going to get some productivity coming in, maybe that's one reason why the markets are not as concerned right now with what inflation is saying.
Well, Jay Powell won't assume what Trump 2.0 will look like, but the market certainly is. What sectors do you think will do well next year?
Well, a lot of it depends on the policies that we see come through, but I think you can imagine we'll probably have CapEx stronger going forward. If you have federal spending come down, that helps on CapEx. It helps corporations in regards to margins. So I think you'll see industrials do well. I've liked financials all year. It's been a story we've had. I think you'll continue to see financials do well. They've had a little bit of consolidation, but you have that deregulation story coming in. You have a positive yield curve. Loan growth should grow. M&A should grow. So that gives you some bumps there on financials as well. We don't invest in crypto, so I'm not going to say that, but it's been going a little crazy there.
You like industrials because potentially the tax rate story, right?
Tax rate and CapEx, I think we continue to see grow in onshoring.
But what about tariffs?
Yeah, I mean, I think we have to separate the tariff story out, and you probably know better than I do when we look at the history of this. I think when you're talking about tariffs as it relates to China, that's one story. I think we can assume that that's going to be pretty quickly. After January 20th, we're going to see some movement there. When you're looking at tariffs for the rest of the world, I know there's been a lot of talks in the conversations with Canada and the conversations with Mexico, but I think that's a different story, and I wouldn't anticipate we're going to see those come to fruition as quickly or maybe as high a level of tariff is what we're hearing right now.
Let's talk about breath. Bad breath. We've been seeing a lot of bad breath over the past 12 days throughout the entire month of December. And it raises the question, is this a taste of what's to come next year? Or if this basically is just a breather of the Trump trade and it will reassert itself come 2025? Where do you fall on that?
I think we do have to be a little bit concerned here. I know we're having a little revival here and tech names are doing well. Yes, NVIDIA's pulling back, but Broadcom's stepping in. So we're seeing those go. But then you look at how much concentration there is in these names. I mean, top 10 names are 37, 38% of the weight of the S&P 500. So you don't have that diversification. You're seeing a little bit more breadth down cap, but I think we have to be concerned when we hit next year and you have the debt ceiling crisis come in and we start to see tariffs go into play. I think we have a little more volatility next year. I don't think this is just a small pause and then we're going to go full-on bull market from here. I do think there are some concerns that we have to be leery about.
What's the hedge at a time where there's equal risks of both some sort of acceleration in inflation or a downturn?
For us and for our clients, it's really being diversified. So not just in your stock picks that you have, but yes, we want to be in the market. You've got tailwinds going right now. I mean, path of least resistance is higher for now, so you don't want to ignore that. You want to be in that market. But we like those areas we talked about. Put some names in financials. Look at some of the industrials, longer-term play. You know, I'm a fixed income person, so I think you still lock in some of these rates. We maybe go up to a 4.75 or so on the 10-year. I think you can lock that in because with global rates as low as they are, I mean, you look at Germany, you're like 2.5, right? We look and see what's happening in China. I think think you can capture some of that as well and have some exposure.
The SNB talking about how negative rates do work. Do you like anything when you're looking at diversifying outside of the United States?
It's tough right now. I would have said a few months ago, yes, put your toe into Europe. I think that they're going to start to see things with the ECB cutting rates. But the issues that we're seeing out of France, the issues that we're seeing out of Germany, the poor manufacturing, there, I mean, we have it here, but it's even worse there. We're seeing a 230 basis point differential between UK and German 10 years. I think you have to be concerned. I need to see a little bit more positive movement coming out of Europe before I think you go there. And Asia, I think, there's some concerns there in China as well. Domestic demand is really slow. We saw it in retail sales. They had the highest month of outflows, like 46 billion last month. So I think there's some concern there. I think you got to stick with the U.S. for now.
Disinflationary, deflationary traps are difficult to get out of. Japan lived it. Europe went through it for a while. Are we seeing that start to take place in China? Is that what that chart of Chinese government bond yields is all about? Is that what it says?
I think that's part of it, but I also think when they're looking at tariffs that could be coming, you see some flight out for that reason, too. There's some concern. You have China saying that they're going to be more proactive in regards to the stimulus that they put forward. They upped their federal deficit. They're saying it's going to be 4% now next year instead of 3%. Not a huge move, but they're trying to do some things. There is somewhat of a trap there you have to be leery of.
Bond market doesn't believe them. Looking at that chart, doesn't believe them at all.
And neither do a lot of other people. I mean, there is sort of a sugar high in the equity markets, perhaps, but realistically, are they going to be able to juice growth at a time where consumers are reluctant to spend? That ultimately is the question.
Victoria, good to see you. Great to catch up. Thanks for being here. Victoria Fernandez there of Crossmark Global Investments. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara Hacker. Say, Yahara.
Hi, John. The Biden administration releasing a study that may complicate President-elect Donald Trump's plans to quickly approve more exports of LNG. The study found that increasing exports of liquefied natural gas would raise natural gas prices for domestic consumers and lead to an increase in global emissions. The report said currently approved LNG shipment amounts are enough to meet global demand for decades to come. Meanwhile, Grubhub will pay $25 million to settle allegations by the FTC and Illinois Attorney General that it deceived diners and drivers. As part of the settlement, the FTC said the online food ordering company will stop adding junk fees, give a simple cancellation method for Grubhub Plus, and notify customers if their accounts have been blocked. Meanwhile, according to ESPN, two-time WNBA champion and three-time league MVP A'ja Wilson is signing a 6-year contract extension with Nike. Wilson's deal, according to the report, is among the highest-paid shoe endorsements in women's basketball, alongside those of Indiana Fever superstar Caitlin Clark and Liberty standout Sabrina Ionescu. Wilson has a signature shoe releasing with Nike in spring 2025, prior to the start of the WNBA season. That's your Bloomberg Brief. John?
Shouldn't they be writing thank you letters to Caitlin? Shouldn't everyone for the extra money they're making?
Well, and then there was the controversy over the cover. Was it the Time cover that had her? Was that the one? And people were saying that she shouldn't have been on there by herself. It was the entire WNBA.
My goodness.
Anyway, but just want to say thank you to whoever put that in the brief to prove my point that that's taking the extra.
We all agreed with you. Yeah. That's why NBA ratings are down.
Thank you. Yeah.
It's not because they're all sitting there trying to shoot three-pointers all the time and the games that got boring.
No, it's
totally about the NBA.
100%.
Who's your favourite player from New York Liberty? OK, up next, the morning calls, plus Greg Peters of PGIM as we count down to the final Fed decision of the year. That's next. This is Bloomberg. No more basketball. Equity futures on the S&P up by a little more than 0.25%. Let's get you some morning calls instead. First up, Bank of America upgrading Expedia to buy, citing signs of improving US travel trends. That stock is up by 3% in the pre-market. Your second call from Baird downgrading Rivian to neutral, noting the uncertain landscape for EVs in the near future. That stock is down by 1.3%. And finally, Morgan Stanley raising its price target on Netflix to 1,050, forecasting another strong year of advertising growth in the United States. That stock is up just marginally. Just hours away from a Fed rate decision and updated SEP. Greg Peters of PGIM writing, our base case continues to see inflation as gradually easing towards the 2% target, with a Fed funds rate eventually settling in the range of 3.5 to 4% in 2025. This may also indicate that the Fed's long-run projection for the Fed funds rate continues to rise. Greg joins us now for more. Greg, welcome to the programme. Let's start where you left off. How much does that long dot need to rise?
I'm not sure about need, but I think there'll be continued pressure on the rate market repricing that longer term dot, right? So I think it's important to remember that, that has changed over time, that adjusts with, the cycles. And I still think in many investors' minds, we're stuck in this past cycle, this, very low growth, low inflation cycle. And I don't think that's the one we're at currently.
So, Greg, that's destination. Let's talk about pace with the destination in mind. There's going to be a different cadence. I think that seems to be the takeaway for a lot of people. It started at 50. We've gone 25 at each meeting since then, again today expected. Greg, how do you think that changes through next year?
Yeah, so I think the market pricing is actually pretty on target. One of the issues that we've had over the course of this year was the aggressive pricing throughout the course of this year. It seems more rational, currently. So you have basically a done deal for today, and then only 50 into next year. So maybe there's some scope if the economy does decay for that to pick up. But on balance, it seems pretty rationally priced to me. And makes much more sense today than it did, let's say, 4 months ago.
Greg, Deutsche Bank put out a note this morning that I keep going back to, and I've repeated it several times this morning, that this has been the third year in a row that markets have had a more restrictive or overestimated how much the Fed was going to cut rates in the following year. And I just wonder, given the fact that we have seen rates stay higher than many people expected, and that we've still seen outperformance from equities, if there is a really strong message about just how high neutral is right now that you're taking to heart.
Yeah, so I mean, the markets are stuck in the past, right? I mean, one of the issues that we've had, quite candidly, is this whole Fed stepping in at any drop of the dime. That's an outdated playbook, right? So we're facing a different battle. That battle is inflation. I think the Fed understands the credibility that comes with being an inflation fighter. So I think the snap reaction that any sign of weakness or wobble that the Fed's going to come in doesn't make much sense to me. But if you think about neutral, I actually think about neutral as a range. 4 to 2.5%. So let's get to 4%. I do believe, though, that the policy rates currently that are set globally are for a different regime as well. If you look at, when policy rates crested, inflation was already coming down. So I think we have to get to neutral. And to me, that neutral is a starting point of 4. So let's start with 4 and then we can revisit.
Greg, is the implication here that you actually see a much greater degree of disinflation in the global market than people currently appreciate?
Yeah, inflation is a tricky one. What I do think, we're on a path, a pretty sustainable path, or a steady path, I guess is a better way to say it. But I think what the markets are pricing in currently and what fixed income traders are starting to fret is that this inflation trend will not only stall out, but reverse. And so some of the weakness in the bond market that you're currently experiencing is that concern that inflation might not be as under control, particularly here in the U.S., as we initially thought. So I think that's the risk factor. That's what you're seeing in the pricing currently, I think. And it's something to watch out for.
Is that risk being driven by what's going on right now in the economy, or is it being driven on the potential outlook for policies that we could see ushered in by a Trump 2.0 administration?
I think it's both, right? I mean, the economy is in very good shape. That has nothing to do with the changeover come January. But there's some inflationary elements that continue to be sticky. You're seeing it on the services side. You're seeing it on the housing side. So some of the elements that were factored in and getting that inflation target, getting us to that 2% inflation target is a lot more sticky. So as a consequence, the markets are pricing that in, and then they're layering on the fact that, immigration and tariffs and all these other factors, all else equal, are more inflationary than not.
How hard do you think it's going to be for Powell to speak with one voice today? I go back to this Nick Timiraos piece 2 days ago from the Wall Street Journal, and he said Powell faces misgivings from some colleagues over continuing to cut and less conviction from others who strongly backed those first two moves. How robust of a debate do you think this is actually going to be?
Well, I don't think anyone really knows. I mean, I think debate is good. I mean, there's so many open questions. To have just this kind of monolithic unilateral decision coming out of the Fed without debate, I think would be irresponsible. So I like the debate. There should be a debate. But I do think what's weighing on the Fed's mind is this inflation picture with the come of these policies that are additionally inflationary. So, I think we'll have a unified voice today. I think the rhetoric will be, much more kind of, less dovish, let's say, because I think they want to set the tone that they worry about inflation. And I do think the narrative has shifted from worry about the labor market to a slightly more concern around inflation.
Greg, not to outsource my job, but what's your one question for Fed Chair Jay Powell today?
The question is, what are those policies? How are you factoring that in? He'll never answer it, of course. But if you go back to the last time tariffs were on the table, they were more worried about the growth impact than they were the inflation impact, right? And so the markets are not thinking of it that way this time around. And I don't know if that's a mistake or not. So to come full circle, if these tariffs do come to fruition, I think the Fed might actually worry about the growth impact, which means more cuts than less than the inflation impact. And so that would be my question.
You're doing Mike McKee's job for him. Greg, appreciate it. Greg Peters there of PG&E. Mike McKee, of course, will be in that news conference a little bit later. If you go back 12 months, do you remember this news conference 12 months ago when he implied they were thinking about reducing interest rates? And then the New York Fed President John Williams came out and said, we're not thinking about cutting interest rates. Then we went into January and we started to get CPI data through the first quarter of 2024, head fake. Then we went into the summer and started to get weak labour market data, head fake. We've gone back and forth, and this is why Rich Clarida, the former Fed vice chair, sat around this table at the last meeting and talked about a Fed chair that needed to find optionality going into 2025. And I think that's what he's got to carefully go about doing in this news conference later.
Does he care about the market response anymore? I remember when that was sort of a barometer of his success,
Sure.
And it seems to be not as relevant as it was, say, in January.
In the inflation years,
yes,
higher equity markets were a problem.
Right, exactly.
Do you remember that?
Yes, well, that's my point. And then people were saying it was a mistake.
Up next, UBS and a view from JPMorgan in just a moment. "60 minutes away from the opening bell. Equity futures on the S&P positive through most of this morning since we've been sat around this table. Equity futures up this morning by about 1/3%. On the Nasdaq 100 up by 0.2, clear outperformance on a Russell. The small caps, we'll see if that particular move sticks. We're up by 0.85% going into the opening bell. With your morning movers, let's cross over to Manus Cranney. Hey, Manus.
Jonathan, good morning. Take a look at this. This is the ADR for Nissan yesterday. Honda pursuing Nissan for a merger. It's certainly not going to be a merger of equals. I can tell you that for nothing. $8 billion is the market cap on this. $44 billion is the market cap on Honda. But this is about creating national championships. This is about political expediency, financial expediency. Senior advisors at Nissan say this: we're fighting for our life. We have 12 to 14 months to survive. So this is about a changing auto landscape on a global scale, whether it's how to survive in EV, survive against China, survive here in the EV market when those credits perhaps are shredded. Either way, this company has a maturity wall of $1.6 billion in 2025. This is as much about financial financial dependency on a deal as anything else. Let's see how it turns out. Honda's a little bit lower, down by 3%. National champions, it's not just China who builds those. Target. Now, John, you pointed this out. This was about an inventory landmine. I think when we did the results just a couple of weeks ago, the stock dropped by 20%. It was a catatonic day for the stock because they have not managed their inventory well. This morning, you've got Evercore going tactical outperform, rising shopping intentions. I'm on the app at the moment. A positive inflection point in the web traffic. I'm part of that. Maybe not for Target, but for another brand. Let's have a look at General Mills. Häagen-Dazs, Lucky Charms, Nature Valley. I don't know anything about these three particular products. I haven't seen these products in a long time. Stock is down. They're lowering the guidance. They're saying it's an uncertain macro backdrop, higher investment levels. Yes, they're holding on to market share here in North America, but it is about price competition in that market, and it's about changing consumer habits and attitudes. I am the reformed in this particular sector.
What app are you on, Manus? What app are you on? Have they killed his mic? Okay. Genius. All right. Manus, thank you.
It's got to be bougie.
Kill his mic. Because of the app he was on?
No, I'm just saying the app he's on is probably bougie.
Oh, right. Okay. All right. Maybe you can come back and tell us another time. Thank you, Manus Craddy. Thank you very much. If you go to the estimates for payrolls, you can look at the ranking on who is the best payrolls guesser, if we can call him that, of the year so far. At number 2 is our next guest, Jonathan Pingle of UBS. So let's bring him in. Number 1. Number 1 is his son, Jonathan T. Pingle, over at Natixis. How cool is that?
I'm looking at this right now, and they don't even put Jonathan Pingle's name, the second one, because it's so confusing to have Jonathan Pingle as first and Jonathan Pingle as second. But that's quite
We
awesome.
ended up with Dad when we probably should have got his son, but this is the next best thing,
Thanksgiving
right?
must be amazing.
Yeah, just jobs guesses.
Yes.
Yeah, we didn't anticipate this complication though when we named him. However,
Jonathan, it's good to see you. Keep it in the family. I think that's absolutely fantastic. Payrolls is behind us. We've had CPI. They were the two big data points going into this Federal Reserve meeting. Lots of people still expect them to cut interest rates, maybe set up a pause in January. Is that how you see things?
yeah, no, I think that's exactly how we see things. I mean, not to be completely.
Is that how Jonathan T. Pingle sees things as well?
I don't know how he sees it. and not to sound completely uninteresting, but yeah, we're expecting a 25 basis point rate cut. I think Chair Powell, really previewed the language he's going to use already in his November 14th remarks in Dallas, where he was talking about, we're not in a hurry. We have the luxury of being able to, move more gradually. And I think that's basically all code for we're gonna skip January. A little bit like sort of Jim Bullard was saying. I mean, they got 90 days until the March meeting to figure out what they want to do next year.
So what are we actually going to learn? Let's say they go by 25 basis points today, as the market is currently pricing 95% chance of. And then they signal some sort of acceptance of a pause or going more gradually early next year. What could potentially get your attention that could adjust your expectations for the Fed in a different way than it currently is?
Well, I mean, we're expecting a number of small changes that I think are actually minorly big deals, if that makes any sense, to the longer run rate coming up, the terminal rate coming up. But I think the one thing that really could change things is how Chair Powell characterizes inflation. I've almost been surprised at how comfortable he has sounded with the incoming inflation data, both at the November press conference, at his remarks in Dallas 2 weeks after that, talking about we've got core X shelter in a range, shelter's going to make progress, really taking sort of the current stickiness in stride. And I think that, when I look ahead to next year and I think about the dot plot, are they continuing to cut, I think their current comfort with inflation is a big part of that. If he comes out and says something, different from that, like, oh my gosh, inflation might end the year at 2.9, we're really stuck here, I think that could really upend how I think of them proceeding in 2025.
Do you think that they should? Do you think that there is any evidence that that is the case?
Well, if I talk to our client base, there are a lot of people talking about how sticky inflation looks right now. The incoming administration, a lot of people think that these are things just directionally, less immigration, tariffs, more fiscal, is all directionally more inflationary when you've already got kind of stuck inflation, not far from 3%. When I look at the data details, it looks to me like they're finally making some progress on rents, and there's a lot of scope for improvement next year as you sort of lap the base effects. So I think they're going to continue to make progress on inflation and continue to cut next year. But I'm not sure that's actually the prevailing narrative amongst a lot of the marketplace.
Do you think there's a bias that Jay Powell has in terms of labor market or inflation? Does it keep shifting?
Well, I think it keeps shifting a lot, but I think it keeps shifting for kind of fair reasons, depending upon how concerned he is, right? I mean, they were obviously very concerned about the labor market in August and early September. You know, the September employment report, I think, took out some of the downside risks in their minds. They're a little less concerned. But I still think he is fundamentally concerned about where the labor market is. I mean, at a headline level, it doesn't look bad, but it also doesn't really look great. You know, I mean, the 6-month moving average of payrolls is 143. Last 2 months is 132. Unemployment rates kind of drifted up to 4.25. Household survey details look kind of weak. You know, I mean, that's all fine in a way, but I'm not sure they want it to weaken from here.
So if it does weaken from here, though, do you think that means the Fed isn't on pause at the next meeting, not today's, and we could see a cut in January as well?
I don't think they're going to cut in January because I would expect the December employment report to look okay. I mean, I think there's nothing indicating to me the economy is going to fall off a cliff between now and the January FOMC meeting. But I do think as they get into March, they consider their sort of gradual pace next year, I do think they're going to signal that they're continuing to normalize over time. And I think part of that is just because they don't want to see the labor market deteriorate much further.
If people aren't worried about runaway inflation, and they are worried about a deterioration in the labor market or the fact that a lot of people haven't caught up fully from the pre-pandemic, pre-inflationary surge, why wouldn't they mind actually running the economy a little bit hot and having inflation closer to 3%?
I mean, that's a fair argument. I've heard a lot of people say, look, workers need to make up some gains here. You know, let's try to run wages so that we can generate some real wage gains and sort of make up for the pandemic price increases. But they are also, on the other hand, I think a little bit worried about, you know, when the inflationary mindset really becomes entrenched in consumers and businesses, that's just going to make it harder potentially for them to reestablish price stability after a period of high inflation. So I think when I think about Jay Powell and I look at the board and a lot of the committee, I do think there is a very kind of human element in how they think about policy. You know, they don't want people, they don't want to hurt the labor market, people's incomes. But on the other hand, they do have an inflation mandate and a price stability mandate that I think they take pretty seriously.
Jonathan, appreciated this. Enjoy the holidays.
Thank you.
It's good to see you. Jonathan Pingle of UBS and the second best labour market economist in the family. Appreciate your time, as always. We're never going to let this drop now. That's amazing. Mike McKee's with us now, Bloomberg economic and policy correspondent. Mike, what are you looking for a little bit later?
Well, it's kind of funny. I'm going to come out and tell you that the Fed cut rates and nobody's really going to care. Everybody on Wall Street's going to go to the back of the book and see who done it. The question is, what do they do next? And I think the first thing we look at is the statement. It has a line in it about in considering additional reductions in the Fed funds rate, we will look at all these different factors. If they stick in the word any additional, that would signal perhaps a pause ahead. And then, of course, the dot plot. Everybody's going to be looking at the dot plot to see not just how many, but how often. And we'll see whether or not that, too, signals any kind of pause. That's going to be the main story for the markets today. You can see what it was last time. Markets think that they're going to go to maybe 2 or 3 from 4 next year. And we'll see if that holds and what kind of signal they want to sell to the markets today.
And Mike, do you remember the highlights last time? The headlines that came from the news conference. We don't assume, we don't speculate, we don't guess. And then a very abrupt, short conversation, which included the word no, I think, twice, and not in the law. Wasn't that it?
Yes, it's pretty crazy.
How different will it be this time around, Mike? That was the immediate aftermath of the election. What do you think the tone of this news conference will be?
Well, I'm not even sure that he'll get asked about his own, Jay Powell, we're talking about his own job now because people know his response. But I'm sure people will ask about the effect of Trump policies going forward, and they'll get the same answer, that we are looking at it, we're modeling various outcomes, but we can't really make policy because we don't know what those outcomes would be. Now, the one thing that might be included in their assumptions is that the tax cuts from 2017 continue. They are set to expire for individuals this year, but The belief is they're going to be renewed, and they are current policy. So if you're looking at current policy and what should happen, then they're going to incorporate that. But the tariff stuff, the deportation stuff, there's just no way they can put that into their forecast right now.
Mike, stay close. We'll come back to you in about 10 minutes' time. Looking forward to it. Michael McKee there. The last time we did this was the immediate aftermath of the election. Remember, it was the Thursday, it was pushed back because it was election week. And one of the pushbacks that you got to any question about changes in policy was that we have nothing to model. Well, we did have a couple of tweets, some posts on X, on Truth Social, about the threat of tariffs and the volume as well, the number that would be put on Mexico, on Canada, on China too. Do you think that's enough to start modelling some scenario analysis, start thinking about what that would mean for the economy, start speculating in a news conference like this one later?
It's certainly been enough for the market. And I guess that the key question might be, this is how the market is perceiving this. How much do you have to take that as fact? How much do you have to watch what the market is doing? And it kind of goes to the crux of this question. How much are they watching financial conditions and measuring financial conditions at a time where that used to be one of the key barometers and transmission mechanisms of monetary policy?
Priya Misra of JPMorgan joins us now, looking for a rate cut a little bit later on this afternoon, looking for 3 more through 2025. Priya, good morning. Good to see you. The 2-year yield has dropped at almost every single meeting this year, with the exception of one. It was back in September. Is this one going to be any different? Will this be another dovish, Chair Powell?
So, I think Chair Powell is going to keep all options open. He's not going to answer what's going to happen with policy. Frankly, he doesn't know. I'm sure they are speculating internally. I'm sure they're debating it. They've got all the scenarios out there. Is he going to tell us before we know the prioritization of the policy mix, the sequencing, the details? So I don't think we're going to hear much. He's going to try and keep options open. But let's look at, you asked about the market impact. We've priced in this hawkish cut. I think the market's done with this 25, assumes that this 25 happens.
Yep.
We're all looking to 2025. And then the market's going to be looking at that dot plot. The market has 2 cuts priced, so 50 basis points of cuts priced in. If that dot plot, and I hate saying that the dot plot doesn't matter. It's not going to matter. What I'm watching is the reaction function. What do they do with the SEP in terms of the economic projections and the unemployment rate? What do they imply with the dots? Is the easing bias still valid? There's a lot of people who think that the Fed should be on pause, on hold after this. If they signal that the easing bias is still there, they want to be careful, continue to recalibrate, they can slow down that pace. That's the balance I'll be watching. If he suggests that they can slow down, but the easing bias is still there, I do think rates can
Let's go with that thing. So when you get the SEP, you get inflation, you get growth, unemployment, you get the dots, you get the longer run dot as well. What is it about how it's set up right now that implies there's an easing bias? And what kind of changes would you look for a little bit later that maybe says perhaps we've taken a bite out of that easing bias?
So I'll be watching what do they do with the inflation target for next year. If they move that up, or the inflation projection, if they move that inflation, they're then getting nervous that this, you've had this hotter inflation prints in the last few months. The Fed actually has not addressed it. I actually think for good reason, because the things that were keeping inflation high, mostly shelter inflation, are lagging indicators. And in fact, the last CPI report suggested that it is coming down. So I don't think that the inflation number will be high, but if it is higher, and they move that long-run dot higher, they may be getting nervous that we're entering this policy fog, really, of next year with an already above-target inflation. The risk is that a lot of that policies end up being more inflationary, and then the Fed may have to pause, not because they think neutral is higher. We are talking so much about neutral. Neutral doesn't move that fast. But I think there's a structural aspect of neutral, but there's a cyclical aspect. If you have this policy mix that's inflationary, the Fed should be much slower in terms of that easing bias. So I'll be watching that inflation, unemployment rate. It's moving up. It's getting back close to 4.3. Is the Fed okay with 4.5 or 5? I don't think they are. I still think they don't want any further weakening in the labor market. So I'll be watching all those projections, and then what do they do with the dots?
Especially at a time when we don't really understand some pretty basic concepts of economics and how the Fed is looking at them. What causes inflation? What effect rates actually have on slowing or speeding up the economy? These sound like really basic things. This is the fundamentals. And yet that is at the heart of all of these questions, including whether they think these rates are actually really restrictive and whether they really are far from neutral. I'm curious how you see them judging what it means to be restrictive in markets that in many ways look like they are even having pockets of exuberance?
So great question. And I think it comes down to soft landings are rare. We don't have that many episodes that we can look at and say we're in a soft landing. Inflation's coming down for supply side factors. We've had a lot of supply side factors. You look at labor supply, you look at the increase in productivity. That's why the decline in inflation has been painless. But does that continue? And so we don't have too many historical metrics. I think they look at the totality of data. I would argue that monetary policy is restrictive for certain sectors, for certain aspects of corporates. If you need to borrow short term right now, it is pretty restrictive. If you need to borrow, if you need to buy products from abroad, it is restrictive. So look at what's happened with interest rates, with the dollar. Financial conditions have tightened in the last few months. If you look at equities and credit spreads, they've eased. So we're looking at an economy that the Fed is a Fed for all people, or now that's, you know, but it has to look at the entirety of the economy. And so I think they will judge that it is restrictive for some and not others. But how much, right? The first 100 basis points was always going to be easy because we knew neutral was not 5.5. But is it 4? I think it's somewhere between 3 and 4. And as the Fed gets close to 4, I think then they have the ability to slow that pace down.
If the Fed comes out and sounds more hawkish than you're expecting or that the market's expecting, do you buy the long end of the yield curve?
I do, yes. I mean, not initially, and maybe not over the next week, because we have a lot of auctions coming in. There's this concern around fiscal policy next year. But here's why I would buy. That means I think monetary policy is restrictive for certain parts. It becomes more restrictive. What happens to equities in that scenario? If they sound hawkish, I actually think the Santa rally that everyone's been waiting for, well, we haven't yet had it in the last 10 days, as you all have been talking about. You get a risk off, and then where do you hide? I don't think it's cash. I think it's bonds. Because if you look at the policy mix for next year, it's two-sided risks, very different from 2016, which was deficit finance, tax cuts, we need growth boost. This is an administration that's looking to rebalance, in my mind. They're not necessarily let's throw more gas on the fire in terms of inflation. So I think you then start to think about where's value. Is it these very high equity valuations, or is it bonds? You're getting 5.5%, 6% stable cash flows from a corporate sector that's strong. That's what you buy, fixed income.
Priya Misra of JPMorgan. We'll end on that pitch for bonds into 2025.
Yeah, at a time when potentially, especially if the Fed is concerned about inflation, that actually will create a sort of a move away from equities into bonds. She also said this, and I thought this was really interesting. This administration wants to balance things. This isn't one that wants to throw gasoline on the fire. So as much as people are talking about this being pro-growth, expansionary spending, is that really the case?
Scott Bessent said that we're going through a Bretton Woods type of realignment, and I'd like to be a part of it. That was his pitch going into the Treasury.
We're going to see some shifts, that's for sure, in the next year. Priya, it's good to see you. Thank you. Thank you very much. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Let's cross over to Yahara Hackers. Hey, Yahara.
Hi, John. The drone saga continues. The Pentagon denying it's involved in any of those mysterious drone sightings over New Jersey and across the Northeast. The Defense Department said none of the drones are being flown by the Pentagon or are part of any secret government tests. Instead, they say a vast majority are likely being used recreationally. President Joe Biden also commenting last night saying, quote, "We are following this closely. So far, no sense of danger." Meanwhile, Boeing is resuming full jet production in the Seattle area after shutting down for weeks due to a worker strike. According to the head of its commercial jet division, Boeing has now begun building the larger 767 and 777 aircraft again. The company cautioning getting production back to speed will take time because some workers need to be recertified and components may be out of position. And cocoa is soaring to new highs. Futures are trading above $12,000 a ton on supply fears amid mounting concerns over a weaker than expected crop in the Ivory Coast. Futures have almost tripled this year, up more than 180%, as poor harvests across West Africa contributed to the worst deficit ever and forced companies to draw down from stockpiles. That's Bloomberg Brief. John?
Hey, Yahara, thank you. Up next on the programme, we'll set you up for the rest of the trading day as we count you down to Chairman Powell at 2 p.m. Eastern Time. That news conference starts 30 minutes later. Equity futures right now on the S&P just coming off session highs. We're positive across the board. We're up 0.1%. From New York, this is Bloomberg. The opening bell is 36 minutes away. As we count you down, equity futures are positive by 0.1%. You're pretty familiar with the day ahead and the week ahead going into the weekend. The final Fed decision of the year coming at 2 p.m. Eastern Time, followed by a Chairman Powell news conference at 2:30. Tomorrow, another round of jobless claims, rate decisions from the BOE and the BOJ, and we get some earnings too from FedEx and Nike. On Friday, core PCE and UMich sentiment. On Monday, if you're still around, Anne-Marie will be here.
All alone.
Conference Board Consumer Confidence. Tuesday, Anne-Marie will still be here. Durable goods data. You're dedicated. That's some important data. Mike McKee will be here to break it down as well. Mike McKee joins us now for more. Mike, you'll be in the news conference. We talked about this just briefly. Give us a flavour of that press conference, the kind of questions that you'll be leaning into at 2:30 Eastern Time.
Well, I think everybody really wants to get at the idea of where they see inflation and therefore rate cuts going. So the line in the SEP about the PCE inflation numbers is going to be very important and probably a key to this whole news conference and what Jay Powell is going to say about it. One thing we do want to mention, we've been talking about how this all affects the Treasury market. Our friends on the money market desks also may get some news today, and that's on the balance sheet, because there's a question now about when they stop QT. A lot of people think maybe first, second quarter, somewhere around the turn of that quarter. So we'll look for any clues or ask Jay Powell if there's any progress on that. And then we're also perhaps expecting them to cut the rate they pay on reverse repos, that special facility that they have, by 5 basis points. This was something that was hinted at in the minutes, and it seems like it's kind of just a technical change, but it could have an impact on QT because it's money market funds putting their cash at the Fed. That cash would have to go somewhere else if they weren't getting remunerated for it, probably into banks, and that would raise reserves. And therefore, you would end up with a slower QT process. So something to watch for.
Mike, are you on purple tie watch at 2:30?
We're always on purple tie watch. It is the one constant in Jay Powell's wardrobe for Fed Day.
Mike McKee, do you notice that?
Yeah.
Purple ties.
Yeah.
Not to get too political.
Exactly.
Right? Purple down the middle.
Oh, can you imagine if he comes out bright red? MAGA.
MAGA with a cap on and everything. I don't think so. Coming up at 1:30, special coverage of the Fed. TK with us around the table. We'll catch up with Bob Michael at JPMorgan and a whole lot more from New York. This is Bloomberg.